Welcome to Trading Tickers, the long and short of it. I'm Tim Grattani, and for the next 16 hours, I'm going to try to teach you everything that I have learned in the market over the last 4 years of trading. Before we get going, I just have to start by thanking my brother Mike for his fantastic video editing work through this entire process, and I have to thank my amazing fiance Donna for putting up with me over the last 7 months as I obsessed over this project. The support both of you offered me throughout this process was invaluable, and I could not have completed this project without you. In Chapter 1, I'm going to tell you a bit about my journey as a trader, the path I've taken to get to where I am today. For the past 4 years, I've been a trader. About 3.5 of those years, I've been trading full-time. Over that time, I've made $2.7 million in net trading profits before taxes. Yeah, I've had my share of big wins here and there along the way, but I have had big losses too that have knocked me back. Overall, what's made this possible is just a slow and steady consistency. I've made thousands of trades. On my Profitly, you can see over 4,000 of my trades that I've made, and 72% of those have been winners. You can also see on this chart that I haven't always been successful. Early in my trading days, I was not making an obscene amount of money. In fact, for a good number of months, I wasn't profitable at all. But as I continued to trade, as I learned consistency, as I continued to grow my account, I slowly scaled up my size, and the results that I've achieved have been beyond what I ever dreamed of being possible. I didn't spend my life aspiring to be a trader though. Let me tell you a bit about the path that led me here. Even before trading, I had the sense that the 9-to-5 job just wasn't for me. I wanted more freedom than that. But I didn't know where to look for it, and being young and naive and a little bit risk adverse, the first place I really looked for it was gambling. Poker blew up early during my high school years. That was back when Chris Moneymaker won the World Series of Poker and Texas Hold'em really caught on. Everybody thought, hey, the average Joe can beat a poker professional and win millions and millions of dollars. And everybody started doing it. Everybody wanted to be the next Chris Moneymaker. And I was included in that crowd. I played home games with my friends, but I also played much more serious games at this traveling poker circuit around the Chicagoland area where you would sit down and put down a couple $100s on the table at a time. And for me, that was very serious money because I was still in high school. My first summer doing it was pretty good success. I think I made about $1,500, which again was great money for a high schooler. And I thought to myself that, hey, I can keep building off of this and I can eventually work my way up towards being that poker pro. I just have to slowly build my bankroll. But unfortunately, there still was the luck aspect. I still took bad beats and I just wasn't as good as I thought I was. I'm sure that a lot of people saw me and just saw a fish sitting at the table full of sharks. So luck caught up and I gave back most of that $1,500, probably even more. I think I blew a decent amount of money on poker growing up. So after poker didn't work out, the next place I looked was football betting. And I got drawn to football betting because of fantasy football, actually, where every single week I was looking at all these players and I was looking at all these matchups and I felt like I knew the teams pretty well. And that kind of gave me the aha idea of, can I use this information to figure out who's going to win what game? So I started picking games against the spread. And as I continued doing it over the course of a couple seasons, I got more and more serious about it and I looked for more and more advanced ways to find an edge. I actually built a spreadsheet for a while where I would import team statistics every single week and then try to use those stats and put together all kinds of crazy formulas to predict scores and predict winners and figure out who might the good bets for the week be based off of matchups. For a while, again, great success with this. I won a free-to-enter contest of about 715 people, I think. It was a $5,000 win, and then from some further bets I placed in order to be able to claim the money, I think I made about $9,000 over one season of football betting from winning this contest. But again, luck caught up to me, and reality caught up to me. I don't know if it was just that I was running good early or if my risk management was just off, but the next season I gave back about half of those winnings, at least. And that was only about 10 weeks into the season. And then I just shut it down. I said, okay, there's just way too much luck involved in this still, and I just can't possibly be consistent at this. So it was just sort of another dream dashed where it just wasn't as easy as I thought it would be. And there was really great emotional strain every day from it. I learned that betting just wasn't going to work and that I was not going to be a professional gambler, which was kind of a hard thing to admit because I only had a year left of college at this point, and I didn't know what I was going to do with my life. I had worked summers at a State Farm, and to be fair to State Farm, they treated me great. I worked with great people, but I still came home at the end of the day just feeling exhausted and feeling crappy, and it had just further confirmed I do not want to work a 9-to-5 job. So what was left? I didn't know. I was a finance major who didn't really like anything about finance. The last place I really had to turn was the stock market. I realized, okay, if I keep this finance major, that's the area that appeals most to me, but I know nothing about it. I knew about long-term investing. I knew about investment advisors and stuff like that. That was kind of the area they pushed you in the program if you were interested in the market. But it just seemed so slow to me and so boring, the idea of buying a company and checking back, 5 years later or 10 years later. I wanted something with a lot more volatility. I wanted something with a lot more action. So trading seemed like the way to go to me, but I didn't know where to look. I didn't know where the trading jobs were. So it was just something I thought I'd dive into myself and learn what I could and gain a little experience, and then just go from there. I still didn't really have a plan. The idea was really just, let's try to make some money at trading and then see what I can learn professionally from it. In late 2010, I opened my first trading account ever. It was a little $500 account at a small broker called ShareBuilder. About 2 weeks in, I had lost half of that account because I was trading with no structure. I had no idea what I was doing. I was thinking of the trades as bets. I didn't want to make 5% or 10%. I wanted to make at least 50%. My idea of a strategy was, hey, I'll buy this 30-cent stock and eventually it hopefully goes up and then I'll try to sell it at 45 cents or higher. And that was it. That was my plan. It was completely naive and I wound up taking a lot of losses as a result. So after 2 weeks of this and after 2 weeks of probably all losing trades, I shut it down and I said, I can't trade like this right now. I need to find more structure. So my next thought was, hey, I'll follow somebody else's picks. I went to where I had gone when I first started football betting. I went to forums where I would go through the forums and look for anybody who might have good picks. And the idea was I'll profit off of the picks first and ask questions later. Later, I'll try to figure out how do they do it? How are they consistent? And how can I be consistent too? How can I do it for myself? But I still was looking for that quick money. Luckily for me, I never found anybody that I deemed to be reputable because they probably would have just been a pump and dump artist and I probably would have lost the rest of my account. Instead, I came across something else that I hadn't expected. When I was going through forums one day, I came across an ad from Tim Sykes. This ad back then, it wasn't all about Lamborghinis or traveling the world or the freedom of a trader. It actually was really great information where I clicked this ad and it took me to a video on basically what is a pump and dump. And it introduced this whole new concept to me about market manipulation and how these worthless companies can run and then how they all collapse. It all sounded very predictable and it sounded like there was an edge there. So it really caught my attention and I decided, okay, this is where I need to be. This is what I need to learn how to do. In February 2011, I decided to join Penny Stocking Silver. There were a couple of reasons I decided to go with the Penny Stocking Silver package. The first being that it was on sale. The second reason, though, was far more important, and it was that it had video lessons. I didn't want to just be a Tim Alerts subscriber, because then I would just be getting trade alerts and that would be it. I did want to follow picks, don't get me wrong, but I also wanted to learn. I wanted to understand what I was doing, and I wanted to learn to do it for myself. My first 3 months of Penny Stocking Silver were just spent learning the basics. I didn't do any trading. I would just go into the chat room here and there. I would watch traders in there, try to figure out who knew what they were doing. I would, of course, watch Tim's video lessons every day, try to understand why he made the trades he did. And I would also watch the trade alerts and just see how did they perform. One thing I unfortunately did also was try to paper trade these trade alerts. And what I mean by paper trade is trade with pretend money, where I would watch Tim enter a trade and I would say to myself, oh, there's the trade alert. Well, okay, now I just bought that stock too. I'm following Tim's pick. And then once the sell alert came through, I would pretend to sell it. And I was really just doing it all in my head, keeping track of it on an Excel. That was it. I wasn't even practicing entering orders. So overall, it was a very worthless experience. I think I did something like 8 paper trades and they were all winners, which is not surprising. because it just wasn't real trading. So after 3 months of doing this, I started trading again in May of 2011. I put $1,500 into my trading account at Thinkorswim. That $1,500 was mine to trade with, it was my own money, it was mine to lose. Now, I was very fortunate over the next couple of months because my parents loaned me some money. They loaned me $13,000, and the point of this money was to open up accounts like at Interactive Brokers that had a $10,000 account minimum, and another broker as well, Speed Trader, I think I went with. Basically, I just wanted to have 3 brokers open at the same time so that I would have 9-day trades a week instead of 3-day trades a week. But the stipulation was that that $13,000 was not for me to touch. I could not trade with that. I could only trade with my $1,500 worth of the money. That money that my parents gave me was only there to keep accounts open, so I respected that. I never took more than $1,500 positions. I never was in more than one position at a time, but that added flexibility of those extra day trades per week from having those extra accounts, it really did help. So once I started trading again, it really was a mix of trading my own ideas and just trying to follow guru picks. And I was following Tim and Penny Stocking Silver, but I also was trying a lot of other free trials at the time. I tried probably 4 or 5 different services just to go out there, see if I could find somebody who could produce consistent winners for me, because I did want to grow my account the lazy way. I did want that easy money. One of my free trials that led me to was Investors Underground, and I probably drove poor Nate crazy because I think I tried at least 2 or 3 different free trials of his service, because I would join and then I would find that when I was at work, I couldn't access the chat room. That software was blocked on the company computers. So I would have this worthless trial, and yeah, I would have access to scans and stuff, but I had access to that anyway. Back then, his scans were free. So through all of these free trials that I tried out, I never really gained much from any of them. The most useful service definitely was Investors Underground, and I really did take away a lot from reading Nate's scans every night. If Penny Stocking Silver was where I learned technical analysis, I like to tell people that Investors Underground is where I learned how to think. I learned the mental side of trading, because Nate's commentary on the plays he was looking at every night, especially the OTCs, I really do think I learned quite a bit from that. And eventually down the road, I did join Investors Underground as well once I had more money. So after a month of trading, I had to go back to work. My school year was over, I was home for the summer, and it was back to State Farm. And at State Farm, I went through a lot of the struggles of trying to trade and work at the same time. Now, I'm not going to tell people that it's impossible, but it really does depend on your situation. And in my situation, I had a lot of the software I needed to access blocked by the company computers. I really was limited to just web-based trading, checking charts just on web browsers, and it really was a tough way to trade. I had email alerts going to my phone so I could get quick alerts whenever a guru entered a trade that I wanted to try to follow, but that was about the extent of what I could do. So at State Farm over the summer, I really was just being a sheep. I would get a trade alert and I'd say, oh, I want to try to buy that. I want to try to make a few extra bucks today. In hindsight now, I think that was a really worthless experience. I think I would have been better off not trading, still just watching the market where I could and picking up what I could, getting that screen time in. But the trading, it didn't amount to anything. Following alerts blindly, especially when you're at work and can't watch it the whole time, it just is no way to trade, in my opinion. So I wish I hadn't done that. I wish I hadn't been pushing those buttons and I had just been a little bit more patient and waited for a time when I really could focus on the market and just spent my time learning. The little bit of time I did have over the summer to trade was before work each day. I probably had about 20 minutes where I could watch plays, make the occasional trade before I had to leave and go to work. So I would just get up and get on my laptop and place whatever trades I could in that short amount of time. By late July, I had a little success between following alerts and trading my own plays, and I was up about $300 total on the $1,500 that was originally mine. So 20%, it really wasn't bad. $300, it wasn't a ton of money at the time, I knew it, but I did see what was possible. I did see that, hey, if I ever do start trading with more serious money, this growth could become a lot more significant and it could be money that I could possibly live off of. Unfortunately, in August of 2011, the wheels came off. I remember having a morning where I woke up, saw that one of the plays I was in overnight had gapped down, and unfortunately I didn't really understand liquidity at the time, and the play was so illiquid I couldn't exit into the panic, and I wound up taking my biggest loss ever. I gave back that entire $300 in profits that had taken me 3 months to put together. It was very demoralizing, it was very frustrating. It was just completely a disaster in my mind. I think I made a few more trades over the summer that really didn't amount to much, and then it was back to school. And I had made sure that for my last semester at college to structure my schedule so that I could spend as much time in front of the market as possible. After a summer of hardly being able to trade, the idea of going back to school and having most of the day in front of the market free was very exciting to me. I was starting to look a little more into short selling. I believed that that was a higher odds side of playing. Since promotions all eventually collapse, I wanted to be on that side of the play. I wanted to catch some of these big tanks. Also, mentally, I was still reeling from this $300 loss that I took that one morning, and I was desperate to make that back. I wanted to recover my losses and get back on track. I wanted to really aggressively grow my account. In my mind, my time was running out. I was going to be done with school soon, and I still didn't know what I was going to do with my life. So trading had to work. Unfortunately, these factors all combined to me getting way too aggressive, really trying too much with short selling, a lot of plays that I wasn't ready for, and I'm going to go a lot more into detail on this on future chapters. But basically, within a few weeks of being back at school, I was down another $1,300 and I had basically blown up my $1,500 portion of the account. And that would have been it for me if it hadn't been for my summer State Farm job and I hadn't made more money, because I wouldn't have been able to refund. So luckily I did make about $4,500 over that summer job. So I was able to say, okay, what's $1,500 more, and refund the account and give myself one more shot. And I knew I had to make changes. I knew that the way I was trading wasn't working. Chasing losses wasn't working. So I came in with a renewed focus and I said, I want to just narrow what I'm looking at. I only want to focus on a couple setups. And the setups I wound up choosing were the long side of OTC promotions. I wanted to learn how to buy new promotions quickly because I constantly saw other traders making huge gains on those. And I also wanted to focus on breakouts because multi-day breakouts was one of the setups that did make sense to me, and I did think I had a real edge in playing. After a few months of this, I ground back to break even. By the middle of November, I had dug out of my $1,300 hole. What this meant was that I now had $3,000 of my own money in the accounts. I had experienced consistency, more importantly though, for 3 months in a row. And this made me think that I was ready to start playing larger positions. So I started playing $3,000 positions. I still was going all in pretty much every play, but I felt like I had an established set of rules now, and for the first time, trading was really starting to make sense. My selectiveness had me only making 3 to 4 trades per week, and that was a good amount for me. I wasn't going in every single day saying I feel like I have to make a trade. There were plenty of days where I just didn't trade at all. It wound up working out for me very well. So after getting back to that break-even mark, November 17th was actually the date of my first big win. The major promoter back then was Awesome Penny Stocks. They would announce a pick and it would spike like crazy and there would be real tradable volume on it. So Awesome Penny Stocks announced AMWI as their new pick on November 17th, and I managed to get a very quick fill on it, and within 10 minutes I sold my $3,000 position for a $2,200 gain. $2,200 was by far more than I had ever made on a trade before, and that trade really was a defining moment for me, because now not only had I ground back to break even over the last few months, but I had my first big winner, and I was comfortably up now, where I didn't feel like I would have to go all in every play. I could really manage my risk a lot better. And it was the first time I just really felt confident that yes, trading can work. Yes, I can make a living off of this. A couple weeks later, when I went home for Thanksgiving, I had the discussion with my parents that I didn't want to look for a full-time job when I graduated in December. I wanted to continue trading full-time. Luckily, they agreed, but I had to meet some requirements. Basically, in order for me to continue living at home and be allowed to trade, we agreed that by the end of March 2012, I would have to make $10,000 for that 3-month period. So I kept on trading for the rest of the year. In December 2011, I graduated from Marquette, and then I moved back home to trade full-time. I finished 2011 decently. I managed to add on some profits to my AMWI gain, and I ended the year up a little bit over $4,000. But then 2012 started, and the pressure set in of having to make that $10,000 in 3 months. While it was very stressful trading under those conditions, I still managed to build up my account. By February 2012, I was now up $12,000 total, already $8,000 for the year. More importantly, I hit the pattern day trader limit. I had $25,000 in total funds between my money and the money that my parents had loaned me. I closed down all the extra brokers that I had opened up, and I merged all of those funds into Speed Trader. And the reason I chose Speed Trader is because my strategy really was long-based, and that was my broker for buying. So I wanted all my money there, and I wanted to have enough funds so that I could trade freely and not have to worry about the pattern day trader rule. I had achieved enough consistency at this point in my initial promotion longs and breakout longs that I felt I could begin branching out to other strategies. So I also used this newfound trading freedom to practice some other plays, such as buying bounces, for example. As I continued to bring in gains, I slowly paid back my parents their portion of the $13,000. And once my parents were paid back, I started moving funds from Speed Trader over to Interactive Brokers so that I could then start focusing on shorting as well. I hit my goal. I made my $10,000 by the end of March, and I continued to trade full-time, and the rest, they say, is history. Since then, I've continued to branch out and learn new setups. My strategies have changed quite a bit as my trading has evolved. I continue to learn every day. I continue to try to improve every day, but I still have a lot of deficiencies as a trader. Some areas that I know I need to work on are position sizing, impulsive entries, and stubbornness. All of those issues cost me profits, sometimes result in losses that are much larger than they should be. And so it's a daily battle, just working through that and trying to find ways to better myself. So there's the brief recap as to how I've gotten to where I am. And I know I glossed over a lot of points, but those are really topics more for future chapters. Next chapter, I'm going to get into a lot more content as far as what I wish I had known as a beginner, things that I think would have really helped speed up my learning curve, really just anything that I think could be useful information to someone just starting out. When first starting out trading, there are a lot of factors to take into consideration, really even before placing your first trade. In this chapter, I want to go over those main factors that I think contributed to my success early, both from ways I approached the market when I was first starting out and adjustments I made along the way from lessons that I learned. So in this chapter, we'll be covering market and trading basics, some basic trader lingo, some details about what exactly short selling is and how it works, trading and computer setups, account building 101, some basic advice I have for people for growing their accounts, overcoming your emotions because emotional issues are a huge struggle in trading, and I think the reason why most traders fail, annoying rules and regulations you need to be aware of, some thoughts on choosing brokers, an introduction to market scanners, and then some handy desktop applications that I use every single day. We'll get started with one of the most basic things in the stock market, which is learning how to read quotes. If you go to Yahoo Finance, this is typically a lot of the basic information that you're going to see right at the top of the page. You'll get information like the previous close, where the last trade took place during regular market hours the day before, or the open, where the first trade during regular market hours of today took place, and then the bid and the ask. And the bid and the ask is what I want to focus on the most here. Now, I took this screenshot probably at 11 p.m. one night. It was during a time when the market was closed, and this bid and ask info was not accurate. But in some cases, you will see bids and asks like this. And just how to read them, what you need to understand is the bid is where the buyers are, and the ask is where the sellers are. So think of it like as if you were negotiating for a new car. The bid is the price that you want to pay for it. The ask is the price that the dealer wants for it. So you're going to have to do some negotiating, and you're going to have to meet in the middle somewhere there. Now, in most cases during market hours, the bid and the ask are not so far apart. In this case right now, they're 37 cents apart. The bid's 403, the ask is 440. So that's a spread of 37 cents. That's a term you'll hear a lot, the spread. And in this case, it's a very wide spread because it's 10% apart. The stocks I look to trade are stocks that have much tighter spreads. Stocks where the bid might be 403 and the ask would be 404 or 405, maybe 406. I want them to be much closer together so that getting in and out is not so difficult. Because what people don't realize when they put in orders for stocks is that they're not guaranteed to fill. They're not guaranteed to get the shares that they want. Maybe you want to buy this stock at 410 and you put in an order to buy at 410. You're only going to fill that order if a seller decides to come down and sell into your buy. So it's really basic supply and demand. You're saying that you want shares for a price of $4.10, but is there a supply to buy from? Is there a supply of sellers who are willing to give you the stock at that price? A lot of the other information you'll see on Yahoo Finance, I don't really pay a whole lot of attention to. The only other couple that are worth noting is days range, so you can see what was the high of the day, what was the low of the day that the stock traded at, and then volume. Volume is big because that's the number of shares that traded during the day. So if your order to buy shares at 410 was for, say, 5,000 shares, and you got filled, the day's volume would go up by 5,000. It would go from 2,306,000 to 2,311,000. While Yahoo Finance is a good place to get information, it is not what I'll use to watch stocks throughout the day. They usually operate on a 15-minute delay, which is a huge disadvantage when you're trading. I can get real-time data from my broker and from watching real-time charts, and that's something you'll see a lot of as we get further into this DVD and you see some of my live trade examples. The next basic concept we need to go over is trading hours. Most people know that the market is open from 9:30 a.m. till 4 o'clock p.m. Eastern Time. However, what a lot of people don't know is how pre-market trading works and how post-market trading works. So for listed stocks, stocks that trade on major exchanges like the NASDAQ or the New York Stock Exchange or Amex, they trade from 4 o'clock in the morning until 9:30. Those are the pre-market hours. For over-the-counter stocks, stocks that don't quite meet listing requirements but still trade on the over-the-counter exchange, those are only open from 8 o'clock until 9:30 a.m. pre-market. Anybody can trade during these trading hours. If your broker does not let you trade during these hours, something is wrong with your broker. You should be somewhere else. In most cases though, pre-market, it's not worth trading. Usually it's very light volume, and you'll have those wide bid-ask spreads like we just saw on the previous slide with VLTC. The buyers and the sellers will be very far apart because there aren't that many who are looking to trade pre-market. So once the market opens and more buyers and more sellers become involved and more people look to trade, that's when the spread will tighten up. That's when you'll see the bid and the ask a lot closer to each other. Because of those wide spreads during pre-market trading, it is usually very tough executions. Like that VLTC example last slide. If you're a buyer at 403 and the nearest seller is at 440, you're either going to have to meet somewhere in the middle or you're likely not going to get a fill. Or the only other option would be you actually buy into one of those sellers at 440 and you pay a huge premium for the shares that you're getting in. You have to get in 10% higher than any other buyer is looking to get in at the moment, which means if you had to turn around and sell those shares quickly, you would have to sell right back to those 403 buyers and you would take a 37-cent a share loss. Now, while the spread is especially wide between that 4 o'clock and 8 o'clock pre-market time, at 8 o'clock, the activity for some stocks does pick up a bit. Sometimes you will start to see a little more volume coming in and a little more action. So if I'm ever thinking about trading pre-market, I'm really only thinking about it from 8 o'clock on. I'm not going to wake up at 4 o'clock to try to trade the markets. After hours trading is very similar to pre-market trading. After hours is open from 4 o'clock till 8 o'clock p.m. And that is only for listed stocks. The OTC stocks do not trade after hours. In some cases, you will see late prints for OTC stocks. Those are not real prints. Those are just market makers balancing their books. So you don't have to feel afraid that your stock is tanking after hours or that your stock is spiking huge after hours or anything like that. Just know that those trades are not real. They will not affect where the stock opens up the next day. But post-market trading, it does have a lot of the same issues as pre-market trading does for listed stocks. Very wide bid-ask spreads, tough executions, really not a whole lot of volume or liquidity. So in most cases, I'm not looking to trade pre-market. I'm not looking to trade post-market. But if some kind of news does come out, it's good to know that I'll be able to, and that is when you would see more activity. If a stock released earnings or if a stock released bad news, then people are going to be a lot more interested in trading before or after hours, and you will probably have the tighter spreads and maybe a chance to make some sort of a trade. If you do want to trade pre-market or post-market, typically you need to route to the market maker ARCA. There are others that will fill, but this is the one that I've heard of the most. This is the one that's most common for when you want to make those trades. But again, you have to be careful of large spreads. Unless I see some opportunity that I believe to be really good for some reason, I'm typically waiting until market open or until the next day, rather than trying to do something before or after hours. Next, let's get a little bit more into discussing the types of orders that you can send when you want to make a trade. I know when I first started trading, this was like another language to me. I was very confused. There were a lot of options out there. I didn't know what I should be doing. The first basic thing you have to understand is the difference between limit orders and market orders. A limit order is where you enter the price that you want to buy or sell at. If a stock is trading at $1 and I want to buy, let's say, up to $1.10 per share, I would put in a limit order at 110. That 110 order would guarantee that I do not fill a single share above that price. I would fill at 110 or lower, provided that there is a seller on the other side of the trade. Otherwise, the order would just sit there and it wouldn't fill. I wouldn't have to worry about having bought at any random price. Now, market orders, they are not as safe. With market orders, you do not enter a price you want to buy at. All you have to really enter is the number of shares that you want to trade. Here's why this is so dangerous, because with a market order, you are guaranteed that you will fill that order. You just don't know at what price. It could fill anywhere. So if it is a stock with a very large spread, for example, that VLTC, where the bid was 403 and the ask was 440, if you put in a market buy order, you're going to be hitting that 440 ask and then possibly even above if all the 440 sellers go away. So with thin stocks, with stocks that have wide spreads, this is especially risky. However, if it is a stock that trades a lot of volume, has a really tight spread, the bid is a penny below the ask, then it's a little more feasible to possibly use a market order. I won't go as far as to say never ever use market orders, but you have to know the risks. You have to understand that you have no control over the price that you buy or sell at. And sometimes you are going to get absolutely crushed because of that. So when I trade, the majority of the time, I am going to be using limit orders. I would rather know the price I'm going to fill at and risk missing a fill if there's no sellers there than risk filling at any random price. Let's talk about a few more advanced order types now, starting with the stop loss order. A stop loss is something that you'll hear talked about a lot in trading. It's the price where you would say, if the stock drops below this level, I want out. So what a stop loss order will do is it will trigger this automatically for you. This is great if you're watching a lot of stocks at one time, or if you have to go somewhere and you can't be in front of the market. You can put in an order to protect yourself, where you could say, hey, if the stock drops below $1, this sell order will become active and I will get out my shares. Now here is the problem with a stop loss order. The problem is that it goes through as a market order. So if your stop loss is $1 and the stock drops below 1, your order becomes active, you're going to sell, but once again, at what price? You don't know where that's going to fill. So you run into the exact same issue, especially if it's a stock with a wide spread or a thinly traded stock. You might get a really crappy execution. Generally, when I'm in a trade, I know what my stop level is. I know where I want to get out if it starts to break below there, but I don't put in that automatic order through my broker. I just keep myself watching. I keep myself in front of the screen, and I'm ready to act if it drops below and use limit orders to get myself out. Now, another order you can use that gives you a bit more control is called a stop limit order. Just like a stop loss, it will trigger if the stock drops below that price that you want to get out at. So in this example, $1, let's say, but you can also put a limit in there with it. So you could say that the order to sell will trigger if it drops below 1, but then put in a limit with it saying, but it won't sell any lower than 98 cents. So any fills you get on your sell order will be between $1 and 98 cents. You won't fill any lower than that. But here's the problem with that. What if you don't fill your entire sell order? What if you can only get out half or only get out a quarter? And then suddenly the stock is down at 97 cents and 96 cents and 95, and it keeps on dropping and dropping, and your order is no longer active because it's below that limit price that you set. Basically, then you're in the position where you have to sit back and you have to wait and hope for a bounce. You have to hope that the stock gets back above 98 so that the rest of your sell will fill. So even though this stop limit option does exist, I still, like I said, will mostly just watch and enter the orders myself. I don't like putting in automatic orders to have my broker do it for me. I will mention that one last reason I do this is because I'm a bit paranoid. I know that even though we as retail traders can't see other people's stop loss orders and where they are, market makers can. Market makers can see all the stop loss orders out there for a certain stock, and they know if there's a lot of stop loss orders clustered around one area. I know a lot of traders who believe that market makers sometimes will manipulate prices to trigger people's stop loss orders and then just rip it right back up above that level to shake people out of their shares, make people take losses so that they can buy those shares back and then let the stock continue higher. Stock market is a very sketchy place and a lot of people don't really play by the rules. Unfortunately, it's especially those who are in the position of the most power. So I'm not going to put my stop loss orders in there and give market makers a chance to screw me over. I'm just going to do it all manually myself. Now let's just touch on a little bit of basic trader lingo, some phrases you might hear that won't mean a whole lot to you if you're new to trading. The first two worth going over are gap up and gap down. Basically, this relates to how a stock opens compared to how it closed the day before. Overnight news can come out, or something can happen pre-market or post-market that will affect where the stock is opening the next day compared to where its last trade was the day before. So gap up is a phrase you will hear when a stock is opening higher than it closed the day before. So for example, let's say a stock closed yesterday at $1 and today it's opening at $1.10. That's a 10-cent a share difference, and that's great for you if you're long, that's terrible for you if you're short. Gap down is the exact same concept, just opposite. Stock is opening lower than it had closed at the day before. For example, once again, stock closed yesterday at $1. Today, it's opening at 90 cents. Great if you're short, terrible if you're long. But these are phrases you should be aware of, and you should be aware that there is risk of something like this happening overnight. Another phrase you might hear is green to red, or red to green. And what do those mean? Well, that relates to when a stock is going from up on the day to down on the day, or from down on the day to up on the day. It's all in relation to the previous closing price, and it's a metric that can really matter to a stock's price movement and to the momentum of the stock. So green to red, that's when the stock goes from being green, being up on the day, to being red, down on the day. It dips below the day's previous closing price. Red to green, same thing, just opposite concept. Stock goes from down on the day to up on the day. It spikes above that previous closing price. Another term to know, and I've already said it a couple times in this DVD, is liquidity. Liquidity relates to a stock's volume. Volume is how many shares were traded on the day, but liquidity is how many trades were there on the day. Basically, if 500,000 shares traded, was it all one big 500,000 share trade between two people? Or was it 500 trades of 1,000 shares each? How many transactions actually occur throughout the day? And the more transactions, the more liquid the stock is. Liquidity is important because it does make it easier to get in and out of a position. The more active a stock is, the more buyers and sellers there are for me to play into when I'm looking to get in or out of a position. One final phrase you need to be familiar with is float. Float refers to the number of shares available for trading of a particular stock. And this is a really important concept that a lot of people don't really understand. Because what float really relates to is how many shares are free trading. A stock might have 50 million shares outstanding, but if a lot of those are restricted and can't be traded, that's what the float is. The float is the remainder that can be traded freely. So why is low float important? And low float is generally thought of a stock that has a float of less than 10 million shares. It's important because stocks with low floats are typically much more volatile. If a stock has good news, there are only so many shares that can be bought. The smaller the float, the less sellers there are, and the less sellers there are, the more severely the stock spikes. So with lower float stocks, it is important to recognize that it is possible for some of these to go on very big runs. You can definitely be a little more patient if long, or a lot more cautious if you're looking to short. I've mentioned shorting a few times now, so let's get into what exactly short selling is. Short selling is where you're making a trade but in reverse. You're selling first shares that you don't have, and then you're buying them back second. The idea is that you're betting on the stock to go down. You want to buy back shares lower than where you first sold them. So you want to sell high, buy low. In order to short sell, you have to borrow shares from your broker. And for a lot of these cheaper stocks, a lot of brokers don't have shares. You need to have the right broker. So if you want to short sell, the first thing you have to do is you have to find shares to short. A couple brokers right now that are very popular for short selling are SureTrader, who uses the platform DAS Trader Pro, or Centerpoint Securities, and they use the platform Sterling Trader Pro. So below, I have a couple images here to show you just of how exactly you might find shares to short. At SureTrader, there is something called the short list. You can access it in the menu of DAS Trader. And in the short list, you can simply type in a symbol and see if there's any shares that you can short. So for example, BIOC, type that in, you see a short size of 2,000 shares. That doesn't mean that there are only 2,000 shares to short sell. That just means that you can short no more than 2,000 at a time. So I could put in 5 orders for 2,000 shares on BIOC to short sell and get short a total of 10,000 shares. That's perfectly fine. But for whatever reason, that's the way they limit it. They won't let you take 5,000 share order sizes or 10,000 share order sizes. You have to do it in order sizes of 2,000 or smaller. NYMX, order sizes of 10,000 or smaller. But VLTC, short size is 0. VLTC, you cannot short at SureTrader on this day that I took the image. Centerpoint Securities uses an application called Sterling Trader Pro, And Sterling makes it very easy. If you look in the lower right area of this order box on the level 2, you'll see in bold the letters ETB. Those stand for easy to borrow. So when you're switching between level 2s and putting in a new ticker, in this case VGGL, ETB is in bold. That means that it is easy to borrow. That means you can short any number of shares you want. Sometimes though, you'll type in a ticker where it won't be easy to borrow. In that case, it won't be bolded out, and you're going to try to find the shares another way. So how do you find hard to borrow shares? Unfortunately for a short trader, I don't think it's possible. What you would have to resort to if the short list didn't say there were any available is you'd have to get in touch with Short Traders customer support and ask them for shares. Ask them if they could get any. And most of the time, you're going to hear no. Finding hard to borrow shares at Centerpoint is far more possible though. They have a locate monitor tool. And here's an image of the locate monitor tool. Basically, you type in the number of shares you want, the ticker, your account number, and then the destination will always be locate in the little drop-down menu, and then you hit send. And then it will kick back to you an offer. It will tell you how many shares it can locate for you and what price you have to pay for those shares. So you do have to pay a fee to get hard to borrow shares, whether you use them or not. Once you locate them, you've paid that fee. So even if you don't make a trade on it, you're still paying that fee. So in this case, VLTC, I requested 10,000. The locate quantity was 10,000. The price they offered me was 2.9 cents per share. So I have to pay $290 total to get 10,000 shares of VLTC. That might seem like a lot of money, but think about it in terms of per share. I'm paying 2.9 cents per share. If I short 10,000 shares of VLTC, can I make more than 2.9 cents per share? If so, then it's worth it. I cover my locate costs, I still make a profit. So once you have your shares to short, now you have to worry about the mechanics of short selling, how to enter your orders. Like I said, you enter your sell order first. In this case with NDRM, the little image I have below here, I entered in my sell order first, I sold a bunch of shares, and my position shows up as a negative share position. Negative 25,996 shares. My position average price, 17.0573. And when I'm ready to close that NDRM position, I just need to buy the shares back, whether that be at a lower price where I'm taking a gain or a higher price where I'm taking a loss. Once you've covered all of your shares, you're going to go from a negative position to showing zero position. So in this image below here now where I've closed out the trade, I have no position anymore. I've realized a bunch of money. That NDRM trade happened to be a good one. That is all there is to it. You short sell first, you buy back second. You want to go from having a negative share position to a zero share position when you are closing out. There are some risks to short selling. You will read on the internet in a lot of places, oh, short selling is riskier than buying. It's a dangerous strategy. You shouldn't do it. And yeah, there's some truth to that. With short selling, there is unlimited potential losses. You can lose more than 100%. If I short at $1, what happens if the stock goes to $4 and I am still in my short position? I'm down 300% on my trade at that point. So you have to be good at cutting losses if you're going to short sell. You can't put yourself in a position to let something like that happen to you. Now, in a lot of cases, you won't find yourself down over 100% on a trade because a broker will buy you in if you get yourself into that kind of trouble. A broker generally will not let you lose more than the amount of money that is in your account. So if I have a $25,000 account and I'm down $24,000 on a trade, if that goes a little bit more against me, the broker's going to just automatically close me out. I'm going to lose my entire account value. But the other kind of buy-in is because of the fact that you don't get to borrow shares forever. There is a time limit on how long you can have shares short in most cases. Usually that time limit is 3 days after you initiate the position. You're going to have to close up. You're going to be bought in. And you have to be aware of that because what if the stock hasn't dropped yet? What if the stock has gone against you? You have to get out. You don't have any control over it. You can't keep waiting. The broker is going to buy back those shares. So short selling pump and dumps, it's not the easiest thing in the world. You have to deal with that time limit, and pumps don't always go down right away. Just because it's a pump doesn't mean it's a short. There are a lot of people who will trade with a mentality of, oh, it's a pump and dump, it's going to go down. But what happens if it goes way up first? You're going to get bought in, either because you're going to be down so much on your position that the broker has to close you, or you'll get bought in because that 3-day limit comes and goes. One last thing to keep in mind when short selling is interest charges. Because you are borrowing from the broker, you're going to have to pay interest overnight. The interest rates vary depending on the stock, but if you're barely break even at short selling, or you're just slightly up, you just got to keep in mind that at the end of those months, your account is going to be hit for those interest charges. So it might turn you from a break even short seller into a losing short seller because those charges deplete your account so much. Usually interest isn't too significant, but I'm just making the point that you need to be aware of it. And it only does apply to overnight shorts. Intraday, you will not be charged interest. Next up, let's get a little bit into trading and computer setups. Probably the first thing any trader needs to think about is their computer setup, the system that they will be using to trade from. Now, an important thing to note about a lot of trading software is that you need Windows in order to run it. So some of these trading platforms that a lot of the big traders use, a lot of the ones I use, are Windows compatible only. So if you have a Mac, you're out of luck unless you run Parallels on it or unless you reformat part of the computer to run Windows. Now that's what I wound up having to do. I had a Mac, and when I realized I couldn't use a lot of my trading software, I reformatted it, I put a Windows installation on it, and so I would boot up the Mac in Windows, and then I could run all of my trading software. Another factor to consider is screen space. It took me a few months to figure this out, where I would just trade on my laptop only, and I'd constantly be toggling between windows, trying to go from one thing to the next, and it was very difficult because sometimes you need to react quickly, whether you're trying to buy a new promotion that you just got an alert on, or sell something because bad news came out. But if you're having to shift windows, that costs you time. That costs you a lot of money because in the market, things can change in seconds. So I learned along the way that I needed more screen space. I needed a little more real estate to work with so that I could spread all my windows out, and that way I wouldn't have to minimize and maximize all these windows. I could just go from one thing to the next very seamlessly. This image on the right here that you see is actually a picture of my trading setup. It wasn't always fancy. It wasn't always these big 3 screens. Right now I have 3 monitors that are 27 inches. I have a ton of screen space. But back then when I was first starting, I didn't need much. That one extra screen can help so much, just one more monitor for $100, maybe even less depending on the deals you can find. It's a very worthwhile investment. It's something that will help you more than you know. Next up, let's talk a little bit about building an account. There are a lot of things to think about when you first get started and you want to try to build up your account and get things off on the right foot. First of all, you need to make sure you fund your account with enough money. A lot of traders start off trading with very little to their name, and they don't really give themselves a chance at success. Also, a lot of traders jump in thinking that they're going to have instant success. They're instantly going to start making money. This could be the easiest thing in the world. That is very rare. There is almost always a learning curve, and you need to be aware of that. Also, pulling money out of accounts. That's a really important factor. And finally, once you're getting started, what kind of trading setups you should be focusing on? What should you look at to give yourself the best odds of success? One of the biggest hurdles traders face when first starting is overcoming commissions. I can't tell you how many accounts I've seen blow up and how many traders I've seen fail because they simply never gave themselves a chance to succeed. Small accounts are very, very tough to work with, and the main reason that is because of trading commissions. You could have a great trading strategy, but if your account is too small and your commission structure is wrong, you're going to get bled down to nothing by your broker. Let me give you a couple of examples. Let's say you start trading and you only have a $500 account. Or maybe you have a larger account, but you're choosing to only take $500 positions. Well, let's think about this mathematically. A 1% gain on a $500 account is a $5 gain. Let's say you're at a broker like E-Trade, where it's $9.99 to enter a trade and $9.99 to exit a trade. That means total round-trip fees are going to cost you $20 on that trade to enter and exit your position, and that's if you only buy once and sell once. So assuming that best case scenario, that means that you need a 4% gain just to break even. That is almost insurmountable long term. You may have the occasional gain that's 20%, 30%, 40%, but you're also going to have losing trades. You're also going to have the small gainers that don't quite work out as planned, and those are the trades where you're just going to get bled down to nothing. Here's another scenario. Let's say you're with SureTrader. Let's say in this case that you have $1,000 to trade with, whether that be your entire account size or whether that be just the position size that you're comfortable taking. At SureTrader, the rate is $4.95 for every 10,000 shares you trade. There's also routing fees to worry about at SureTrader. The cheapest OTC routes are 1/10 of a cent per share. So let's say you're looking to take that $1,000 position on a penny stock. You want to play something really cheap because you know that the cheaper it is, the more volatile it is. So let's use a 2-cent stock in this example. If you want to take a $1,000 position of a 2-cent stock, you need to buy 50,000 shares. 50,000 shares on SureTrader's commission structure means that you're paying $24.50 in trading commissions round trip, but then the routing fees are what are going to really cripple you. That's $100 round trip. So on that $1,000 trade, $124 are going to the broker, which means you need a 12.45% gain once again just to break even. To give you guys an idea, I've been trading for about 3 years now, and my stats on just my winning trades, I average just under 6% gain per trade. In both of those situations, I would have a very, very hard time being profitable. And actually with the SureTrader example, I would be losing long run because the fees would just be eating me alive. Bottom line is, you have to be smart. You have to find the broker that has the best fee structure for the kind of stocks that you want to trade. If you want to trade the really cheap stocks, you can't go to a broker that charges per share and has routing fees because you're going to get crushed. Or if you want to trade more expensive stocks where you're trading a smaller number of shares, you don't want to be paying a high flat rate per trade. Maybe then the per share structure makes more sense for you. So figure out your goals, figure out what you want to trade, and then pick the broker and the commission structure that is the best fit. Don't be one of the guys complaining about your broker and about your fee structure and how it's crushing you and blaming them for all of your problems. This is your responsibility to understand. This is your responsibility to figure out for yourself. If you want to be a trader, you have to take charge, you have to take responsibility, and you have to make these important decisions. It does all come back to making sure you start with enough money though. You don't want to be trying to take $100 positions, $250 positions, $500 positions when you're first starting trading. That is how you put yourself in the situations where you need those big percent gains just to break even. I mentioned that when I first started, I had $1,500 of my own money to trade with. And for me, that unfortunately meant that I had to go all in every play because I was making sure that the commissions would not eat me alive. Now that was incredibly stressful, and it really added a lot of strain on me emotionally, having to basically risk my entire account every single play that I made. So if you know that in that situation you would be really uncomfortable, you probably should be saving up your money until you can afford a large enough account where you can still take those larger positions where you're only going to need 1%, maybe 1.5% to get that break-even point without putting your entire account on the line. I'm not going to say it's fair, and I know it stinks to have to wait to do something that you're excited to give a try and that you think might change your life. But unfortunately, trading is not like it's marketed by a lot of people. It's not the easiest thing in the world that anybody can do. There are a lot of small steps you have to take to give yourself a chance at success, and this is one of them. So you have to take responsibility, you have to suck it up, you have to save up as long as it's necessary, and then give yourself a chance to overcome those commissions. Let's also talk about the trading learning curve. How long it takes for people to find success. I'd say 99% of you aren't going to find immediate success. And that's not a knock on you, that's just another reality of trading. There are so many subtleties to it, and even the best traders, pretty much anyone I know now who's a millionaire or has had great success, they've all blown up their accounts at least once or twice. Now this might seem like a conflicting idea to what I just talked about, but it really goes hand in hand. It's important to trade small early. I know that's weird when I just gave a big speech about how you need to be able to take large enough positions to overcome your commissions, but what I mean by trade small is keep it in that range where you're not going to lose more than a few $1,000s. Something that's recoverable, something that you can make from a summer job. I've talked to traders before who start off trading with $60,000 accounts. For some reason, in their first few weeks of trading, they're trading full size, they're playing huge, and before they know it, within weeks, they're down 40 grand. $40,000 is much, much harder to recover than just a few $1,000s. You don't want your blow up to crush you beyond a possible recovery or giving you a chance to possibly try again. When I first started trading for real, it took me 9 months of watching video lessons, of trading, of making mistakes to find any kind of consistency at all. And like I mentioned in the first chapter, I did blow up my portion of the account once. And I was lucky that it was only $1,500 and that was a recoverable amount for me, that I could refund and that I could give it another go. Because those mistakes were ultimately what taught me the most, and I needed to make them in order to take the next step forward. The question you need to ask yourself when you're getting started trading is, can you afford 6 months or more with no trading income? If the answer is no, you should not be trading full-time yet. You need to have some other kind of job, some other kind of income. I've had people approach me asking if they can fund their trading accounts with a credit card and go into debt. That is a terrible idea because you're not going to make that money back in the first month. You need to expect a slow and steady learning curve, and you need to expect failures along the way. So if you're in need of immediate income, if you think that trading is going to be something that will get you rich really fast, you either need to wait before you start trading or you need to look elsewhere, because that's not what this is. Another factor that a lot of people overlook when it comes to building an account is the need to pull money out. There's a few main reasons why people may decide to take money out of their accounts. The first and most obvious reason is that you need that money in order to pay your bills. If you put your entire life savings into your trading account and trading is your only source of income, where are your bill payments going to come from? Even if you start off trading and you find immediate success, the need to take out money and pay your bills every month basically results in every step forward you take one step back. And that's your best case scenario. If you have a losing month, what happens then? Then your account is depleted because of some poor trades, not to mention the money that you have to pull out at the end of each month to pay those bills. This is why I recommend people really save up enough money before they start trading. Because if you don't have another source of income or some extra money to fall back on, you really are at a huge disadvantage. Another reason you might see people pull money out of their accounts is to reward themselves for good trading. Whether you're 6 months into trading, a couple of years into trading, whatever, if you've had a lot of success along the way, you probably want to splurge a little bit. Now don't get me wrong, there is nothing wrong with rewarding yourself, but you need to do it in moderation. I know some traders who have had a lot of early success in good market conditions, blown a lot of that money rewarding themselves on frivolous things, and then when the market turns, they can't make that back nearly as easily as they expected. Reward yourself in proportion, be smart about how much money you spend. Don't cripple your account and set yourself back to square one, assuming that it will always be as easy as it was the first time. Finally, taxes. I know that this is something I overlooked when I first started trading, and I'm guessing a lot of other traders are in the same boat. If you profit, a lot of that money is going to go to the government, unfortunately. At least in my personal experience, that money has had to come from my accounts when I've paid my tax estimates along the way or when I've made my final yearly tax payments. It was very frustrating to me because, again, it went back to that feeling like I was taking one step forward and one step back. And this really does tie in to being smart about rewarding yourself or any large frivolous expenses. Because if you forget about taxes and the fact that a large portion of your profits are going to have to come out of your account for that purpose, there's a decent chance you cripple yourself. Never forget that trading takes money to make money, so be sure to leave enough to give yourself a real shot at success. I know I just went through a lot of boring money management tips, but when people ask me how to build a small account, I know that usually they're asking me in terms of what should they trade, what setups are the best for them to look at. In my opinion, no matter what niche you want to focus on, you need to make sure that the stocks you're looking at are volatile. Volatility is scary to a lot of traders because, yes, a stock moving around with a very wide range could lead to a large mistake if you do not cut your losses well. But the nice thing about volatility and what I took advantage of with volatility is the fact that you have such a wide window of opportunity. You can mess up, but you can still have a nice profit. When I started trading, my focus was way too wide. I was trying to trade all kinds of different setups. I had no real idea of what I was doing on any of them. I just felt like I was kind of blindly throwing darts without any real edge. One of the most important changes I made to my trading was I picked a niche and I stuck to just 1 to 2 setups. The ones that I was most comfortable with, the ones that I felt like I understood the best, really the ones that fit my personality best. I'm not going to tell you what niche to focus on. That's something you need to discover for yourself along the way. As you try different trade setups, figure out, what are you most successful with? What are you most comfortable with? Where are you the most consistent? Once you can figure that out, once you can pinpoint those setups, that is what you should focus on. Every person is different, and what works for me may not work for you. But building a small account is all about finding consistency. So once you have that niche, once you know what side of the trade you're more comfortable on, stick to that and cut out all the extra trades. That especially includes guru picks. A lot of traders join services with the idea of following picks and getting rich quick because the guru makes money, so why can't they? I did the exact same thing. But the reality is that is not how it works. You can't match entries, you can't match exits, and in a lot of cases where the guru has a winning trade, you might be trying to take the exact same trade and wind up with a loser. For all the time that I spent blindly following picks, I really didn't learn anything. I would often find myself in a trade where I had no clear-cut strategy. I had no idea of when to get out. I really was just waiting for the guru to tell me. Instead, take charge. Figure out the setups you like best. Figure out how to identify those setups on your own. And that doesn't mean you can't learn that setup from a guru, but become self-sufficient. Self-sufficiency leads to consistency, which leads to profits. That is how you start growing an account. You certainly do not do it by following guru picks. When it comes to scaling up size, I think a lot of traders go about it the wrong way. I think a lot of people think about it in terms of once you have the bigger account, you can go ahead and start trading bigger. And to some degree, yeah, that's true. But I think it's important to note the nature of how you got to that bigger account. Did it just come from one or two big wins? Or did it come from consistent profits? A setup where you know time and time again the odds are massively in your favor, you've had success with it before, basically you know that it's something you can trade with confidence. Once your account is bigger, it doesn't mean that all of a sudden you have to start trading twice the size you did before on everything you're trading. Size up where it makes sense for you. When I narrowed my focus early in my trading career and I was focusing on just new promotions and just breakouts, I was having consistent success there. And that is why I sized up, and that's why I was able to start really getting some exponential growth on my account, because the consistency was present. And then when I started learning new setups or trading other setups that I wasn't quite as familiar with or didn't have that confidence or that consistency yet, I would trade smaller. But especially early in your trading career, keep your size under control. Even if you have that early success, don't be in a rush to do too much too soon. One of the biggest challenges in all of trading is overcoming emotions. I really would go as far as to say that emotions are the reason that most traders fail. Trading really requires the ability to stay disciplined. And once those emotions kick in, it is very easy for that discipline to fly out the window for one reason or another, and you start making mistakes that cost you money. There are so many emotional struggles that traders go through, and I've gone through quite a few myself. Some of the main ones I remember that I want to talk about are, first of all, the fear and adrenaline rush when entering a trade. This was something I really struggled with when I first started trading. It came from a couple places. It was the fear of failure and the fear of losing money. I've also had quite a few times along the way where I've slipped into a home run mentality. I want a big winner, and I start pressing, looking to make that big winner happen. Another huge struggle is admitting when you're wrong and cutting a loss. And then in a lot of cases, that can also lead to trying to make back losses. Again, just pressing, trying to make something happen when really there might not be opportunity there. Finally, an emotional issue that I still struggle with today is the fear of missing out, where there's that one play that you're so excited for, that you've been stalking for a while, and you get so worried that you might miss it, that you take an impulsive entry as a result, and it ruins your entire trade. In theory, these all sound easy enough to avoid, but once you have that money on the line and you're in the moment and you're in the trade, everything changes. But let's talk a little bit about what you can do to hopefully control these emotions a little bit. Like I had said, when I was first starting to trade, pretty much anytime I entered a trade, I'd have this huge rush of adrenaline, just this pit of fear in my stomach, a little bit of excitement also, but it really was impacting me because I could have a plan, I could know what I wanted to do going into the trade, but it would just fly out of my head. I would have no idea in the moment what I wanted to do anymore because my heart rate would be so jacked up, my hands would be shaking, and it's really hard to keep a clear head and think under those circumstances. And a lot of it was just that I didn't trust myself. I didn't want to lose. I was so afraid of failure, I was so afraid of losing, and that was leading me to make bad decisions. It was very important to me to succeed. It was very important to me to be good at this. What I had to take a step back and realize, and what kind of dawned on me as I continued trading, is that losses are a part of it. It is okay to lose. In fact, it's expected that you should lose sometimes. It isn't always the end result that matters. I learned to focus more on my process. If I was in a trade where it was just a bad idea and it wasn't working out, would I cut my loss? Or would I get stubborn and let a loss balloon on me? That was what mattered to me. If I tried to play a breakout, for example, and the breakout just didn't work, that's fine. I still knew it was a high odds setup. I still knew that more times than not it would work, but there will be those times that you're going to take the loser. What I wanted to avoid and what I learned to avoid was holding on to that loser and making it even bigger because I didn't want to admit I was wrong. Now, if you can get yourself to that point where you are constantly sticking to your plan and cutting losses where you say you will, but you find that you're consistently losing and that you're not coming out ahead of the market, maybe the problem then lies in your plan and you need to make a new one or find a new strategy to focus on. It's important to be able to recognize that too. But taking that step back and looking at your trades and figuring out why you're losing is very important. So I would constantly track my trades. I would constantly break down what I was doing right, what I was doing wrong, and if I could identify the areas where I was going wrong, I would do my best to correct them. And as you gain that experience, and as you trade for longer and longer, that fear, that adrenaline, that excitement entering a trade, it will start to wear off. Of course, my fear of losing didn't just come from the desire to be good at trading. I would say the biggest contributor was the fear of losing money. And that really was a situation that I put myself in. Although I had borrowed a lot of money from my parents, the only money I could trade with was my own. And pretty much all of the money to my name at that point was in my trading accounts when I first started. So I did feel enormous pressure to succeed because if I blew up my portion of the account, I had nothing to fall back on. Even a bit later in my trading career, once I had had some success, I mentioned in chapter 1 that I had had a deal with my parents that I had to make $10,000 trading full-time by March 2012 in order to continue living at home and being able to trade. I had to prove that I could make it work, and that again put on just a huge pressure to make money. Now, the simplest answer would be just don't put yourself in those situations. Like I've talked about earlier in the chapter, save up, give yourself a real chance at success. Don't have that pressure to profit always hanging over your head. But that's not always practical. And when you do have that pressure, what do you do? How do you deal with it? And there is one thing I did along the way that I think made a big difference and really shifted how I look at trades and my ability to keep a level head when I was in a trade. And that was when I hid the unrealized profit and loss column on my brokers. Here's why that helped. I would find myself in a trade many times where I would be staring at my unrealized profit loss column. I would have it staring me in the face, telling me how much I'm up or how much I'm down on my position. And I could only look at that for so long before I would just feel like I had to do something. I either had to lock in that gain or I had to cut that loss. I didn't want to see that number change for one reason or another. So when it really boiled down to it, I was trading based off of my profit and loss. I wasn't looking at the chart anymore. I wasn't concerned about the setup. I was concerned about the money, and I knew I had to change that. So my solution was I just got rid of it. I got rid of that column. I didn't have it staring me in the face anymore, and I was pretty good at math, so I still had a decent idea in my head of how much I was up or how much I was down. But just to not see it, to not have it staring at me, it made a huge difference mentally. I stopped worrying so much about that money, and I started worrying a lot more about the chart. And that gave me a chance to let my winners run more. That gave me a chance to be able to sit in a trade while I'm down a little bit, even though my stop loss hasn't been hit. I wouldn't get scared out for reasons that had nothing to do with the chart. I think it was around the fall of 2011 when I made that change, right around the time when I started to get consistent, and I don't think it's a coincidence that those two things lined up. As for all the other emotions that traders struggle with, I'm not going to claim that I've found all the answers. I still struggle with a lot of them to this day. I know a lot of other veteran traders do as well. I think the one that still gives me the most trouble is the home run mentality, looking for that huge win. It's something I've always slipped into throughout my trading career if I go a few weeks or maybe even a couple months without what I feel like is a big win. because then I start trading bigger, I start pressing, I start trying to make it happen on my own. I've yet to really find a concrete solution for this. Usually what happens to me is I take enough losses that it kind of snaps me back to reality and I say, what the heck am I doing? Another issue that can be tough to deal with and that I think is the most deadly to traders is the ability to admit when wrong and cutting a loss. I've always done a pretty good job of this, but my biggest losses come from the times when I have a breakdown in discipline and I fail. Really, a couple things I try to do just to keep myself cutting losses and staying disciplined is I constantly remind myself of the quote, "Hold and hope is not a strategy." I love that quote, and if I find myself in a position going against me, I pretty constantly have it going through my head reminding me. I also try to constantly ask myself, is the stock doing what I expected and what I planned for? If the answer is no, I have to try to force myself to get out. But really the best learning tools and the best ones to remember are the times that I got my ass kicked. The times where I didn't cut that loser, the time I really let one balloon on me. I've had several massive losses in my trading career. And while I would have preferred to avoid those entirely, I'm constantly using them as a reminder, trying to make sure I don't repeat the same mistakes. Now, losses aren't avoidable, and sometimes you are going to take a big hit. And when that happens, it opens the door to the emotional issue of trying to make those losses back. Slipping into that mentality again where you're pressing and trying to make something happen when the opportunity isn't necessarily there. This has happened to me after almost every big loss that I've taken. And for me personally, I've found that the best solution is I just have to force myself to take time off. I need that time to clear my head. I need that time to calm down, get myself off of tilt so I'm not trying to just make it all back. Times when I have failed to do this have just led to more losses. And again, it's the reminder of those losses, it's the reminder of those mistakes that helps me allow myself to take that time off. Usually after a week or two, I come back feeling refreshed, I come back feeling refocused, and I get back to the basics and I'm right back on track. The final emotional issue worth discussing is the fear of missing out. Like I mentioned earlier, fear of missing out is where maybe you've been stalking a play for a week, maybe you just have some setup that you really, really like, but you're so afraid that it might happen too fast for you to execute that you take an early entry. This is a mistake I find myself making quite often. And from all the times I've made the mistake, what I've found is that early entry, it makes it very, very tough to stay comfortable in my trade. Really what this ultimately leads to is a lot of dumb losses, where maybe I did overall have the right idea, big picture. Maybe I did have the right thesis. But because I had that bad entry, because I wasn't comfortable, it led to me panicking out when I shouldn't have. Or it led to me taking profits way too early. It affected my decisions in a negative way, and I really would have been better off if I had just sat back and been patient and waited for my ideal spot. As far as dealing with this goes, the only thing I've really been able to come up with so far is just trying to constantly remind myself that I will miss plays, and that is okay. It's far better to miss out than to take a dumb loss. And even if it's a case where I might have taken that early entry and had a profit to show for it, I'm not reinforcing a good habit. More times than not, that impulsive entry is going to hurt me. So I just need to remind myself to develop good habits. Throughout your trading careers, you may come across some emotional issues that I didn't mention here. You may struggle with these. You may find your own solutions that I haven't thought of yet. But if there's one encompassing lesson for all of these, it's that you need to be self-aware. You need to be able to take a step back, examine yourself, figure out what is going wrong, where you're at mentally, where you're at emotionally, and you need to be able to fix it. If you can't do that, emotional mistakes are probably going to destroy you. Now let's get a little bit into some of the annoying rules and regulations you're going to have to deal with throughout your trading career. A lot of these I was not aware of when I first started trading, and they came as very annoying surprises. I hadn't planned for them, I wasn't prepared for them, and it just made the whole process of becoming successful take longer. The first rule that everybody needs to be aware of is the pattern day trader rule. What is a day trade? Well, a day trade is when you enter and exit a stock on the same day. Different brokers count day trades in different ways, but the majority of them, if you buy a stock, sell half the position, and then sell the other half of the position, both in the same day, that's going to count as 2 day trades against you. Why are day trades important? Because if your account is under $25,000, you only get 3 of them every 5 business days. If you happen to go over your limit, if you make 4 day trades in a week, your account gets frozen for 90 days. Obviously, this is a huge disadvantage to small accounts. It severely limits your ability to trade freely, and it forces you to be very, very selective with which opportunities you choose to trade. When I started trading, this was something I had to deal with. The way I chose to get around it was I opened multiple brokerage accounts, because it's 3 day trades every 5 business days per broker. So, with that extra money my parents gave me, I was able to keep 3 accounts open, and that way I had 9 day trades every 5 business days instead of just 3. But now there's another option. There's a broker called SureTrader that is located offshore, which means they don't have to enforce this rule. So at SureTrader, small accounts can trade freely, and I'll talk about them more later in this chapter when I get into brokers. Another rule you need to be aware of if you're looking to be a short seller is the 250 rule. Again, this is one that totally blindsided me. I had no idea this rule existed, and it completely prevented me from being able to short sell like I had planned on. What is the 250 rule? Well, it applies to short selling stocks that are less than $2.50. Basically, it's a way that brokers manage their risk. For every 1 share that you short of a stock, it means you have to put up $2.50 in capital. So if the stock is under $2.50, you can't short your entire account value. So here's a couple examples to make this a little clearer. If you only have a $2,500 account, that means you can only short 1,000 shares at most, no matter what price the stock is. So if you're trying to short a stock that went from a penny to 10 cents, and you're really excited about the opportunity because it's a pump and dump and it's up 1,000% and it's going to crash, well, you can only take 1,000 shares of that 10-cent stock, which is only a $100 position. Even if you have a $10,000 account, it's not a whole lot better. You can still only short sell 4,000 shares at most. So this really impacts you if you're looking to short sell cheap stocks that are really the blatant pump and dumps, those penny stocks. When I started trading, there were a ton of pumps, and I wanted to short sell them, but this really hindered my ability to. So what are some solutions? Well, there's really only one, and that's that you have to find a broker that doesn't enforce the rule intraday. This is something, again, that I'll get more into once we get more into brokers later in the chapter. One final rule to be aware of, and this impacts all accounts regardless of size, is what short sell restriction is. Now, short sell restriction only applies to listed stocks. This doesn't get put into effect on OTCs. What is the rule? Well, it's the rule that you can only short the stock into an uptick. What causes this rule to be enforced is if the stock is down 10% or more on the day. Once the stock hits that negative 10% mark, short sell restriction gets put on for the remainder of the day and then the following day. It doesn't matter if the stock comes all the way back. It doesn't matter if the stock closes green on the day. That restriction is going to be on for that amount of time. This can be annoying if trying to short sell charts like on the right here. If you want to short a big support crack, you're not going to have the opportunity to get a fill. You would only be able to short into rebounds. And as you can see here on the right on this chart, after this big morning support level cracked, there was really no opportunity to get a rebound to short into. Everybody would have missed this trade because short sell restriction was on and there was no way to fill into that weakness. So it impacts how you trade because you have to plan ahead a little bit. You have to maybe anticipate a little bit more and get short before that crack happens rather than trying to wait for it to snap. If you think all of these rules suck, I definitely won't disagree with you. They've caused me a lot of headaches over the last few years. But unfortunately, it's something we all have to deal with. So plan for them, be ready for them, don't be totally blindsided by them like I was. Now I want to get into the process of opening a brokerage account. One of the first things you're going to have to decide when you open your account is whether you want a margin or a cash account. I think the best choice is a margin account. And there's really a few main reasons why I choose a margin account. First of all, you have to have a margin account in order to short sell. If you have a cash account, the broker will not let you do it. Another big advantage of a margin account is that your funds clear faster through it. I opened a cash account when I first started trading at Thinkorswim, and what I was surprised to discover was that I would close out a trade and then I wouldn't be able to use my funds that were involved in that trade for another 2 or 3 business days. That's because these brokers have something that's called a settlement period where the funds need to clear. If you have a cash account, you have to wait that few days for the trades to settle. But if you have a margin account, if the trade you made was intraday, you get the funds back immediately. And if the trade you made was an overnight hold, you get the funds back the following trading day. So that way you don't have to sit on the sideline waiting for your money to clear if another good opportunity arises. One final thing a margin account allows you to do is use leverage. What leverage is let's say you have a $1,000 account and your broker offers 4-to-1 intraday leverage. That means that during the trading day, during regular market hours, you can purchase up to $4,000 of a stock as long as it meets certain requirements. Generally, they won't let you do this with OTC stocks. They won't let you do this with really cheap stocks. But the more expensive stuff, you can take larger positions than your account value. Now, I don't recommend doing this. This is not something that I've ever done. I don't like the idea of risking more money than I have in my account. But also, if just one trade goes wrong and you're using a crazy amount of leverage, it becomes so much easier to blow up. So don't put yourself in the position where you might owe your broker money. Even though you might have a margin account, just trade the amount that's in the account that's yours. That's what I do with mine. The next step you need to take when opening a brokerage account is to make sure you get the necessary market data. A lot of times people will get confused, and I've been in this spot before, where I have my broker, I try to look up a stock, and it won't show me the price. And that's because generally it trades on an exchange where you have to purchase the market data. You have to pay a little bit extra per month. You see this most with OTC stocks, I'd say. But if you find yourself in the spot where you are starting to trade with a new broker and you're not seeing any kind of market data that you expect to see, chances are you need to go purchase a market data subscription. This brings me to my final point. Take advantage of the live support that all these different companies offer. Almost all brokers have a live chat feature where you can ask questions specific to your account and get quick answers. One thing that always kind of leaves me scratching my head is when I'm in a chat room and I see a new trader asking total strangers why they can't see a certain stock quote or why their broker won't fill them on something. Just stuff that's really specific to them that people in a chat room would generally have no idea about. Maybe sometimes you can get quick advice, but the best place to go is to your broker's live chat. Ask them the questions. Pick up a phone, call them. Ask the people who are experts, ask the people who can pull up your account, see what your settings are, and they'll be the ones who can give you the best answer. So definitely take advantage of it. If you have a question, that's the place to go. Next, I want to talk about specific brokers, because really choosing what broker you're going to use is one of the most important decisions you're going to make as a trader. You need to pick the right tool to suit your needs. Also, some of these brokers can help you get around some of these rules that I just talked about. When choosing a broker, I'm not going to say there's a right or a wrong choice. What you need to figure out is what features are the most important to you. What is the right choice for you? Different brokers have different strengths. So you need to pick the one that has the strength that will best suit your strategy. Is it that you want shares to short of stocks? Is it that you want the ability to short stocks longer term? Are you trying to avoid the pattern day trader rule with your small account? Or maybe you don't want to have to deal with the 250 rule intraday. Maybe you're looking to trade OTCs on the long side like I did when I first started trading, so you're looking for a broker with quality OTC executions. Or maybe you just want to keep fees down and not have to pay a fortune getting your fills. Unfortunately, you're probably not going to find a broker with all of these characteristics. You're going to have to make choices, so make the choices that are best for you. One other angle you need to be aware of is the different platforms for trading that brokers offer. A quote that has always stuck with me that Michael Good said was that web-based traders are losing traders, the ones who are just trading from their little web browser. You need to download the broker software. You need to have those tools at your disposal. I think it is well worth the extra money for platform features. Some platform features I use on my brokers every day are level 2 feeds, real-time charting, the ability to use hotkeys for quick and easy order entries, and market scanners, something I use to find plays, which is something we're going to get more into later. Almost all of these features are not something that you can get just by trading off of your Firefox browser. And it does open a whole new door of things to consider, such as how much do the platforms cost per month? What features does each platform offer? but it's something else to be aware of when making your choice. What I'm going to do now is I'm going to run down some of the brokers that I use every day, the ones that are my favorites because they're right for me. The first one I want to talk about is SpeedTrader. I've used SpeedTrader since I started trading, and the reason I use them is because they have excellent OTC executions. They have a lot of different routing options, a lot of places you can send your orders to make sure that you're in the front of the line to get a fill. They have a per share fee structure, or they have a flat rate fee structure, so you can choose whichever one fits you best. And I love their trading platform. Even though I don't trade with them that much anymore because I don't trade OTCs too much these days, I still use their platform every single day for their level 2. Their level 2 is by far my favorite. Also, their routing costs are a lot lower than a lot of other brokers. A lot of brokers charge on a per share basis for routes. SpeedTrader, most of their routes are per trade, just $2 per trade. So that helps keep my costs down. SpeedTrader recently opened another branch called SpeedTrader Pro. Now, this is actually a different broker technically, but they also have great locates in addition to a lot of the other features I just talked about. So while I wouldn't normally use SpeedTrader for short selling, SpeedTrader Pro is somewhere I would look to go if I was looking to get shares to short as well. The reason I don't use SpeedTrader very much to short sell is because I'm very happy at Centerpoint Securities. Centerpoint is by far the broker that I use the most. Centerpoint has two different clearing firms. They have the ETC clearing firm and the Wedbush clearing firm. I have accounts with both clearing firms because each clearing firm offers different borrows. ETC, I would say, has more stocks easy to borrow every single day, but when it comes to very late in a promotion or very late into a huge runner, you cannot get shares to short. Very often the stock will be restricted. One thing to be careful of with ETC is the fact that lately they have been very unpredictable with their buy-ins. A lot of clearing firms will give you at least 3 days with your short, but ETC recently, if their stock goes restricted, they can just buy you in, no notice, and you will have no control over where you fill. So holding overnight at ETC, I don't really do that anymore on the short side because there's a lot of risk to it, and I don't want to lose control of where my shares get covered. Their other clearing firm, Wedbush, is what I use for hard to borrow plays. Wedbush still does have a decent number of stocks easy to borrow every single day, but come the end of a big pump and dump when everybody is looking for shares, I know Wedbush is where I can get the locate. And usually I do have to pay a fee to get that locate, but just to have the shares makes it more than worth it. I've been very happy with Centerpoint the entire time I've been with them because they've always had great executions, especially on the OTC stocks. OTC executions can be a struggle. I'll talk about that in later chapters, but Centerpoint has always done a great job in my opinion. They also offer a lot of routing options, just like SpeedTrader. When it comes to trading platforms, I believe they offer 3 different ones, so you can pick the trading platform that you are most comfortable with, but most importantly, they do not enforce the 250 rule intraday. Now, what I mean by intraday is that during market hours, you do not have to worry about the 250 rule. Once the market closes, if you're holding a position overnight, then they enforce it. Then you have to be very mindful of how many shares you have in relation to your account value. But to be able to trade freely during the day, not worrying about the 250 rule, it's a huge advantage. Now, unfortunately, Centerpoint does have higher fees. What I like to tell people, though, is you get what you pay for. I don't mind paying a lot of fees to them for routing and for commissions because all of those other features make it more than worth it to me. But the other thing about Centerpoint that's a little bit frustrating is they have high account minimums. You have to have at least $30,000 to open an account. So for a lot of new traders, it's not an option. I didn't join Centerpoint for at least a year and a half. But when I did, I was so glad because they were a great fit for my trading needs, and they really are a broker now that I couldn't do without. While those are the only brokers that I use, there are a few others that I think are worth mentioning. The first is SureTrader. Now, SureTrader is a broker that, like I said earlier, they're located offshore, and that means that they do not enforce the pattern day trader rule. I did briefly use SureTrader way back when they first opened and I had smaller accounts. And it was great because they got me around the pattern day trader rule. There are a lot of things about SureTrader I don't like, and I've heard a lot of complaints from people who are still with them. But if I had a small account, that's probably where I would be trading because I would want so desperately to be able to trade freely and not have to deal with the pattern day trader rule. One specific weakness I remember about SureTrader is that their OTC fills were wretched. It was almost impossible to get timely entries and exits, so this is an example of needing to make a choice if you choose to trade at SureTrader. If you want to both trade OTC stocks, but also get around the pattern day trader limit, you probably can't do both there. So if I were that new trader, if I had that small account, I would have to make my decision. Do I want to go to SureTrader, trade freely, get around the pattern day trader rule, and focus only on listed stocks? Or do I really want to stick to my guns, trade OTCs, and if that was the case, I would have to choose a different broker. One broker I might choose if I was looking for good OTC executions would be E-Trade. Another broker I briefly was with. I was pleased with their fills when I was there, and I thought that their costs were relatively low because I was trading a large number of shares and they charged a flat rate trade structure with no routing fees. Also, I believe recently they got a hard to borrow division, so they also are a decent option for short selling. While I'm not currently with them, they are a broker I might consider going back to. Finally, Interactive Brokers. Interactive Brokers has its advantages and its disadvantages. I thought Interactive Brokers was a very low-cost broker, and they had decent locates. The problem is that they would have a limited number of shares, so it was a first-come, first-served basis. That didn't allow me to be precise in my entries, especially on the stocks where they had very few shares to short. If you do get the shares to short there, though, one of the biggest advantages is that they usually allow longer-term borrows. Most brokers will allow you to short a stock for a limit of 3 days, and then they buy you in. Interactive Brokers is the one place I can think of where you get a chance to hold that borrow for longer. So if I were looking to short longer term as my strategy, I would open an account at Interactive Brokers. All of these brokers I just mentioned are ones that I have some experience with or ones that I'm familiar with. That's not to say there aren't others out there, so do your research. Read lots of reviews, check out different company websites, but really put in the time and find the best option for you out there. Let's wrap the chapter up by getting into some of the tools that I use every day to help me with my trading. The first and by far most important tool that I use every day is a market scanner. Market scanners are a fantastic way to find new stocks in play. Basically, what you can do is you can input different variables, such as how much the stock is up, what sector it trades in, how much volume the stock has traded on the day, whatever you want really, and the scanner will bring back to you results of any stocks that fit your criteria. I've tried a lot of scanners, and there's 3 that I like best. There's Equity Feed and Stocks to Trade, which basically is the exact same software. Or there's Interactive Brokers, who we just talked about. They have a great market scanner with their platform. I used them for a very long time before switching over to Stocks to Trade. The reason I like these 3 best is because they have the most input variables. You can really refine your searches and make it very specific to what you're looking for, so they really save me a lot of work. There are some other options for scanners out there though that are free. There's a free trading platform called Thinkorswim that's offered by TD Ameritrade. They do have a stock scanner, but it lacks a lot of the features that those last 3 I talked about do. Also, a website called finviz.com. Again, you can use it for some very basic scans, but they are going to be lacking some features. If I had to, I could use these scanners, but it wouldn't narrow down my search quite as much as I would like, and I'd have to do a little further work on my own. Here I want to show you just a basic example of what a stock scanner is. This is the Stocks to Trade application. On the left, this is where you can put in all of the trade criteria that you want to. I have it set to show me all stocks where the dollar volume on the day is over $3 million traded, the stock is up 10% or more, the last price is under $15, and the stock has had more than 3,000 trades on the day. On the right, after I run the scan, this is what gets kicked back to me. A list here of these 8 stocks on the day that met my criteria. Right now, this is just a brief example, but in a couple chapters, we are going to get a lot more into how I run my scans, how I build my watch lists. We really will cover this topic in a lot more detail. Finally, let's just go over a couple of other handy desktop applications that I use every day. Mozilla Thunderbird is an application that allows you to get pop-up email alerts. Now you might be thinking this is something you can do with a web browser, and you'd be right, but I actually went as far back when I first set this up to time it out and see which application I got alerts faster with. And Thunderbird gave me alerts about 5 seconds faster is what I found. And we know that in trading, seconds can make a difference. So if you want to try to buy a promotion quickly when you get an email, Thunderbird is the application to use. Twitter can be another place to get important alerts on stocks. And TweetDeck is an application that will give you pop-up notifications as soon as a new tweet comes out. Now, this isn't something you want to do with your main Twitter account, because if you're following 100 people, you're going to constantly be getting pop-ups. You're not going to know which ones are important, and it's going to drive you crazy. I use TweetDeck, and I have a second Twitter account where I only follow a select few accounts. The ones where it's either a promoter I feel is important that could put out a pick at any time, maybe it's someone who's really good at posting news on stocks as soon as they come out. But find the accounts that you think are most important, cut out the rest in the noise, and TweetDeck can be a huge asset. Finally, I mentioned this application earlier for market scanning, but Thinkorswim from TD Ameritrade. It's a free charting software. I've used it for as long as I've traded, and it's an application I've grown very comfortable with. They do offer level 2, however the level 2 information can be inaccurate at times and also a little bit delayed, so I don't like to use them for that. But if you're looking for good real-time charting software, Thinkorswim is a great place. There's no obligation to put money in, at least not last time I checked. Hopefully this chapter gave a lot of you beginners some idea of what to look at and what to think about when first getting started trading. But now I want to get a little more into the mechanics of trading and some of the basic things that go into my trading strategy when it comes to making actual in-the-moment decisions. Chapter 3 is going to focus on a lot of the basic elements that go into pretty much all of my trading strategies. We're going to start by talking about some basic technical analysis, pretty much what indicators on charts I use to make decisions. Then we're going to get into the importance of volatility, which was a very important lesson I learned early in my trading career. We'll also be covering how I judge risk, and then get into some general thoughts on trading both OTC and listed stocks. There are differences to how I'll approach trading these two different types. Finally, we're going to talk about level 2. I'm going to get into a lot of the basics of what I look at on a level 2 feed, and then I'll use recordings to show a couple examples. This first slide may seem like common sense to a lot of people, but believe it or not, when I first started trading, it wasn't common sense to me. And that's that you need to be using candlestick charts instead of line charts. Day one of my trading career, the only experience I had ever really had with stocks was looking at charts on a Yahoo Finance page. And that always displayed as a line chart. And it was just a nice smooth line usually, connected point to point. And that was comfortable to me, and I liked that. It made sense. But really, I was missing a world of information. But before getting into that, let's just get a look at what exactly a candlestick chart is and how you read it. When you're looking at a candlestick chart, you're going to come across a couple different types of candles. Green candles, red candles, and white candles. Let's start just by taking a look at this green candle right here and what the points mean. You'll see in the dead center here there's a box. And what the box represents is the bottom of the box is the price point that the stock opened at in this time frame. So this could be a 1-minute chart, this could be a daily chart. It all depends what time frame you set and what you want each candle to represent. So if the bottom of the box is where it opened, the top of the box is where it closed. So if this was a daily chart right now, that means that on this day, the stock opened at 141 and it closed at 142 because the bottom of the box is 141, top of the box is 142. You'll also see though that the box has a wick coming out of each end. The bottom of the wick, in this case 139, is the low, and the top wick is 144 in this case, and that is the high. So those are the 4 points you get from a candlestick. The high, the low, the open, and the close. But what if it's a red candle? Let's take a look at this one for example. And it's the same sort of idea, it just works slightly differently. The 4 points still represent high, low, open, and close. But in this case, since it's a red candle, and that means it ended down in that time frame, the open is the top of the box, and the close is the bottom of the box. So in this case right here, it opened at 144, it closed at 141. And again, the time frame all depends on whatever you set it at. The only case where you would see a white candle is if the opening price was the exact same as the closing price. So I said the candlestick charts give you far more information than line charts, and now let me show you why. Take a look at these two charts below, for example here. The chart on the left being the line chart, the chart on the right being the exact same chart, but candlestick form. Now, if you're looking at just the line chart, what you're seeing here is you're seeing a couple tops that are probably right around the 27-cent area, and then you're seeing one little pullback that was down just under 25 cents, maybe in the 24 or 23.5 area. So if you're trying to play off of the line chart, you're playing off of those resistance and those support levels. But now let's look at the candlestick chart. And if you look at the candlestick chart, all of a sudden now you can see how high the stock really got on those days and how low it really got on those days. And the reality is that the resistance level it set up isn't really 27 cents. In fact, it's topped out twice at 29 cents now. As far as how much the stock had dipped, well, it had been a lot more than that 23.5 area. It looks like this red candle on day 4 of the promotion here got as low as about 17 cents. So even if line charts are all you know and they're all you're comfortable with, push your comfort zone, get over to candlestick charts, because that is where you're going to get the most complete information. Once I had finally learned that candlestick charts were the way to go, I did have to decide what kind of indicators I wanted to use to read these charts, what technical analysis metrics mattered to me. I started off using basic support and resistance levels in order to read charts, and I never changed. I liked to keep it simple. No moving averages, no advanced indicators, that stuff just wasn't for me. Support and resistance made sense to me. I saw it working time and time again, so that's what I wound up sticking with. Aside from just looking at key price points like support and resistance levels, I'm also looking at the volume and liquidity of a chart. That is a huge focus, especially on the daily chart. I want a stock that trades a lot of volume, where it's possible to take sizable positions. I've found that illiquid charts are far less predictable. When a stock is trading good volume, and we're talking millions and millions of shares here, that is when I'm the most interested in possibly making a trade. My trading decisions, they come almost entirely based off of what I read on the chart, what I see on those key support levels, what I see on those key resistance levels. So what do I mean by these resistance and support levels? Well, let's take a look. So this chart we looked at earlier, AMLH, that was a good example of a daily resistance level that's formed. We talked about how 2 times the chart has topped out at this 29-cent area. And that's something I'm going to take note of. And that's something as down the road the stock breaks past 29, I'm going to be interested in buying. You could also look at this from another perspective. Maybe you're short biased. So the way you could handle it then is you could say, hey, the stock has spiked to 29 2 times. Both times it's failed to break through. So maybe I can take a short position and risk off that 29-cent area. Whichever way you choose to approach it, you're recognizing that 29-cent area is a key resistance level. So you can try to find different ways to play off of it. Recognizing daily support levels is pretty much the same thing as recognizing daily resistance levels. You just have to reverse your thinking. Take the chart AGEN below, for example. After a couple of big up days in a row, the stock began to pull back, and for 5 days in a row, it held 530 as its bottom. Now again, whether you're long biased or short biased, there are ways you can use the support level to your advantage. If you're long biased, you can buy the stock risking off of 530, saying, well, 530 has held 5 days in a row, so I anticipate that it will continue to do so. Or if you're short biased, perhaps you can short sell it once it breaks below that 530 mark, anticipating that the key support break sends it lower. Either way, there's a play to be made. If you take the idea of support on a chart and resistance on a chart and put it together, you get channels. Here's an example of a 3-month-long period where Fannie Mae was stuck in a price channel between 260 resistance and about $1.97 support. For this entire 3 months, whether you're long biased or short biased on Fannie Mae, there are plenty of ways to play it. You could be buying dips anytime it gets near that $2 area. You could be short selling spikes anytime it gets near the 260 area, using each level as your risk. Or you could simply wait for one level or the other to break and then take the appropriate play. The ability to recognize a channel is great though, because it gives you a chance to make multiple plays while putting the risk reward in your favor. You can take these same ideas and apply them to intraday charts as well. Below you'll see the chart RNN, which had topped out at exactly $1 a few times midday before finally breaking past that $1 resistance level late in the day and having a really nice spike into the close. Obviously they don't all work this well, but in this example, whether I'm long or short, I'm playing off of that $1 level. Same thing goes for intraday support. Below you see ARRY, and midday it held this 760 level multiple times. Again, whether I'm long or I'm short biased, I'm paying attention to that 760 level. And then even the next level below that. Let's take a look at this 725 area. If 760 cracks, I probably turn my attention to that because in the morning, that was where the pullback wound up holding. Ultimately, it really doesn't matter what time frame you're using. The principles are the same. I'm looking for areas where the chart topped out and held. I'm looking for areas where the chart bottomed out and held. And I'm using those resistance and support levels to make my decisions. Next, I want to get a little bit into the topic of volatility and how volatility, I think, is absolutely key in finding stocks worth trading. When I started to experience consistent success, one of the things I came to realize is that I only wanted to be trading the most liquid and volatile stocks. What is volatile differs from day to day. I may trade a stock one day and then never trade it again. I don't get attached to the ticker, I don't get attached to the name. I'm just attached to the price action. I want it to be familiar price action. So my focus is constantly shifting. I wait for different stocks to give me familiar setups. I nail the familiar part of the move, and then I move on to the next one. I don't get hung up on any one particular stock. This chart I'm going to show you next is the stock that finally taught me this lesson. And the ticker of this stock was LBAS. LBAS was some crappy OTC company. I don't even remember what their product was, to be honest. But in my very early days of trading, I was interested in this chart because it had run from 40 cents up to a high of $1.30. Unfortunately, I missed this part of the move, and I also missed the ensuing few days when it faded all the way back down to 60. When LBAS caught my attention again, it was in September, and it was during this period of time where the stock was just going sideways on the daily chart. Every day, the stock had a range of maybe 5 to 10 cents at the most. If you also look at the volume in September, it was probably only trading about 1 million to 1.5 million shares per day, much less than it had been in August when it was at that point where it peaked out at 130 and then had the few days of fade right after. So volume was down and volatility was down. But for whatever reason, I was very attached to this stock. I thought, hey, it's a pump, it's gonna fade, it's gonna crack and fail. I want to be there for when it happens. And so I became obsessed with just this one ticker. And I kept on trying to short sell it again and again and again, all while it was going sideways, all while the volume was low, all while there was really no volatility whatsoever. And the result of this trading was loss after loss after loss. I would take my short, hoping that it was about to collapse. It would hold up, I would get scared, and I would cover into an uptick. It's not that any one loss was all that large in particular. It was probably only a few cents a share every time. But the point is, I took so many losses trying to trade this sideways stock. As a result, this was the stock that wound up blowing up my $1,500 portion of my first account. But while those losses sucked and it was really demoralizing to have failed, this was a huge lesson to me. I learned that you cannot trade sideways action. You cannot trade illiquid action. Since then, my focus has been on volatile stocks, my focus has been on liquid stocks, and the results have been far more consistent and far beyond anything I had ever dreamed was possible for myself. Another element to my trading strategy that I think is really responsible for my success is the way that I measure my risk. I see a lot of traders who try to approach the market with a one-size-fits-all approach. They'll go in and they'll say, I'm not going to lose more than 5% on any trade. And yeah, that's fine. I guess it keeps your risk under control. But the problem is, you're going to be cutting a lot of losers in very strange places on the chart. I think that I am successful because I let the chart guide me in the decisions that I make. I let the chart show me where to cut a loss. I don't have some preconceived number in my head telling me this is when I need to get out. I refuse to let money control my decisions. I refuse to let some random percentage control my decisions. I want to make my decisions based off of what matters, and what matters is price action. So how do I determine my risk then? Yes, I use key support and resistance points on the chart, but how does that translate into making sure I don't lose too much money on any given trade? Well, the main thing I look at is how far my entry is from the risk level that I'm planning to play off of. The further away from my risk level I am, the smaller I'm going to play. But the one thing I have to determine before I enter the trade in the first place is how much money am I willing to lose on this trade? And then I size in appropriately based off of that. Yes, I still take big losses, but the big losses I take are because I get stubborn. My risk level comes and goes, I don't take my trade off, and next thing I know, I'm way underwater. So I don't attribute that to a failure in how I manage my risk reward. I attribute that to a failure in discipline. So here's some examples on how I judge risk. Let's use this chart of AEMD. Now let's say I'm looking to short sell this chart around midday when it's been kind of going sideways for a while. And I go ahead and I take my short entry right around 40 cents. I have a decision to make now. What is my risk level going to be? Is it going to be this 42-cent resistance level that it just peaked out at? Or is it going to be the high of day, this 45.5 resistance level? If I'm playing off of the 45.5 high of day resistance, I need to play smaller because I'm risking 5.5 cents per share now. Whereas, if I'm only going to risk off of 42, I only have to risk 2 cents a share, so I can play a little bit bigger. It all depends on how I want to manage the position and where I plan to cut the loss if things go wrong. Let's take a look at it mathematically. Let's say I'm willing to lose $500 on a long trade. And on this particular long trade, the stock has a key support level of $1. How should I responsibly build into my position to only lose $500 if I have to cut the loss? Let's say my entry is at 105. That means I'm risking 5 cents per share because my loss needs to be cut at $1 when it breaks down. That means with my 5 cent a share risk, I can take 10,000 shares. Now, what if I enter much worse? What if my entry is way, way higher? And now I'm in from $1.20. Now my risk is 20 cents a share. So I'm going to have to play smaller if I don't want my loss to be more than $500. And now I can only play a quarter of the position size I would have been playing if I had entered closer to that support level. I can only play 2,500 shares. This is how I'm constantly thinking when I'm entering trades. I determine how much I'm willing to lose, I see where my entry level is going to be, and then I size in appropriately. But that way I am always playing off of the chart, I am always letting price action guide me, and other factors do not come into play. This idea really ties in well to my general trading mentality, which is to trade the ticker and not the company. And what this means is that things like fundamentals or news or earnings, they really don't matter to me. I'm more interested in the price action. I'm more interested in the chart and what that tells me. I don't care about what the numbers might indicate. I care about how does the stock react. So really, I am just constantly trading off of technical analysis. Fundamental analysis does not come into my trading strategy whatsoever. Now, that doesn't mean that I won't know the company at all. I do need to know basic information. I do need to know, for example, when a stock has earnings coming out, or when a company might have upcoming news, if there's an expected FDA decision or something like that. Those things matter, and they matter because I don't want to get stuck in a situation where I might be holding a stock overnight and then all of a sudden earnings hit after hours and the trade completely changes. Holding into earnings or holding into some event like that is just completely gambling in my opinion. I've seen a lot of cases where people will talk about a stock going into earnings and saying, oh, this company is expected to have great earnings, it should go up. And everybody jumps on the bandwagon and everybody's expecting the same thing. And in a lot of cases, even if good earnings do hit as expected, everybody already bought. Everybody was expecting it. So once those earnings hit, all those buyers turn into sellers and the stock plummets. And then everybody's confused because they say, wait, what happened? The good earnings came out like expected. So the moral of the story here is even if you think you have an edge, you probably don't. So I just avoid the situations altogether. I let the earnings come out, I let the news come out, and then after that event is out of the way is when I start to look to trade the stock again. When it comes to actually finding stocks worth trading, My approach is the same whether it's a listed stock or an OTC stock. I always start with pulling up the daily chart. The daily chart is the most important factor to me because I want to look and see if there's a familiar big picture. Is it a familiar pattern on the daily chart that makes me think there is some opportunity on trading this intraday? I'm also paying very close attention to the volume on the daily chart. How does the volume relate to the previous year? I'm looking for charts that are trading much higher volume today than they normally have been over the past year. I also will be looking back on the chart, seeing when the last time was that the stock did trade large volume. And when it did, what were some key resistance and support points? What was the high? What was the low? I'm looking at areas that I could possibly play off of. Finally, I'm looking at the trade count on my scanner. Usually it is my scanner that finds me these plays. Trade count is important because sometimes volume can be a mirage. A stock could trade 500,000 shares on the day, but what happens if 400,000 of those shares came in one trade? So I need there to be a large trade count, something that shows me that there is a steady flow of volume. There are a lot of trades going through on it. It isn't just one or two big blocks. Whether it be OTC or listed, I trade with the mentality of let the trade come to you. I don't try to predict momentum. I don't try to guess what illiquid stock is going to be the next one to run big. I don't try to guess how significant the news that just came out is. I'm going to let the market show me. I'm going to let the trade come to me. And once I have that familiar daily chart pattern, that's when I attack. Because I take this approach and don't try to predict momentum, usually by the time a stock is ready for me to trade it, it is up a lot already. But that's okay with me. I want to let the chart develop. I want to let the predictable trends form. For me, it's all about finding the predictable piece of the move. So I find my opportunity, I catch the predictable piece, and then I move on. Of course, I do trade both OTC and listed stocks, and there are differences to how I approach both of these. So let's get into some of those differences, starting with OTC stocks. When it comes to stocks that trade over the counter, my mentality is that all of them are manipulated scams or just terrible, trashy companies. And that applies whether there is an obvious promotion or not. The reason a stock trades on the OTC market instead of on the listed markets is because it's a small, unstable company that doesn't meet listing requirements. The three charts you see below are charts of marijuana companies: TRTC, GRNH, and VPOR. Last year, all three of these had very large runs during the marijuana craze, during the time that everyone thought marijuana stocks were going to go to the moon because states were starting to legalize. None of these had blatant promotions done on them. There wasn't some newsletter pushing them saying buy shares now. But when all is said and done, these chart patterns look exactly like pump and dumps. To find that one OTC stock that makes it, that uplists, that eventually goes from a few cents up to $10 or more, that is incredibly rare. If that is your goal, you might as well buy a lotto ticket. So while yes, I may play the long side on some of these sometimes and try to catch some of the upside move during the big runs, I never lose sight of what they are. I always remember that they are trash. Another factor unique to OTC stocks is that level 2 can be a very, very useful tool. On the OTC market, executions are not instant. And in a lot of cases, this leads to stacking action on the level 2, on the bid side or on the ask side. In a few minutes, we're going to get a lot more into level 2. I'm going to show you some examples of exactly what I'm talking about, but this is unique to the over-the-counter market, so I pay far more attention to level 2 when trading OTC stocks because there's an edge there. One thing I have to mention about the OTC market is that it has been very slow lately. I saw a lot more OTC stocks halted in 2014 than I ever had before, and I think that scared away a lot of the traders for them. As a result, there's less opportunity in the OTC market, but there is still the occasional play that comes along that's worth trading. But I don't let myself lose sight of the fact that there were more halts last year, so that means that now I will not hold overnight nearly as often as I used to. Getting caught in a halt is pretty much an instant 50% loss at least for when the stock reopens, so it just isn't worth the risk. Once the OTC market died off a bit, I was forced to transition into trading listed stocks far more than I used to. Listed stocks, I've learned to anticipate far more choppiness than you'll see in the OTC market. My philosophy has become sell spikes and buy dips because of that fact. There are so many fake out moves on listed stocks that buying that afternoon high day break just isn't as appealing as it used to be. Too many times I see that move get stuffed, and buying into that strength or buying into that spike is going to result in a loss for me. So now I try to do the opposite. Every now and then I will make exceptions. There will be setups where I still will buy into strength or sell into weakness, but those are few and far between. I really do believe that selling into the spikes, selling into the strength, and buying into the dips and weakness, I think that that is the better risk reward. Level 2 on listed stocks, it really isn't nearly as useful compared to OTC. You don't get that same stacking action because there are instant executions. One thing you can do with level 2 on listed stocks is you can see the big bids and asks. That can offer an advantage sometimes, but aside from looking for big bids and asks and how the stock reacts to them, I am trading mostly off of the chart when it comes to listed stocks. I may not have level 2 as much to aid me, but I can still use that price action I see on charts to my advantage. I've mentioned level 2 a lot in this chapter, so now let's dive more into that and get a look at exactly what I'm talking about and how level 2 functions and how I use it to my advantage. If you're new to level 2, what you're looking at right now might be a little bit overwhelming. But let's just start with the basics here, we'll break it down slowly, and then we'll get into some more advanced ideas later. So right now what we're looking at is a picture of a level 2 feed next to the time and sales tape for ECIG. Basically what level 2 does is it shows you market depth. It shows you the different buyers and the different sellers at different prices. Over on the left hand side, you see the buyers. On the far left here, these 4-letter abbreviations, these are different market makers. And the market maker could either be trading for themselves or they could be processing a client's orders. The next line over is the price that they're looking to buy at, and the final line over is the size of the trade. Now on my level 2 feed here, I have it divided by 100. So even though it shows 50 here for CSTI, the reality is that's an order size of 5,000. For CDEL, it might show 180, but I know that that's really an order size of 18,000. Different level 2s could do this different ways. Some might show the real size, some might divide by 100. I feel like the format I'm showing right now is the one I see the most often though. Over on the right hand side, it's the exact same thing, except it's sellers instead. So again, you have the market maker, you have the price, and then you have the size. The second piece to the puzzle is the time and sales tape. And that is to the far right over here. Now time and sales is actually a list of all the trades that are going through on the stock. So these prints you see in this box right here, these are actual trades that went through the market. The far left is the price, of course. The middle column is the quantity, the number of shares that traded. And far right is the time, what time the trade went through. You might notice that there's a lot of different colors here on the time and sales tape, and that's because the color will tell you where the trade took place. So in the case of this red print, the top print here you see at 1061, 5,000 shares traded at 9:46 and 15 seconds. The reason that is red is because that means the trade went through on the bid. That means somebody's sell order hit the CSTI bidder sitting here at 1061, the order filled, and there you have the 5,000 share trade at 1061. It shows up as red because it took place on the bid. The print right below that is green, and that is 1066, 15,000 shares, and that was 5 seconds before. Now it looks like this must have happened before some of these market makers changed their prices and came down to be a little bit cheaper. But the reason it was green is because that means it went off on the ask. Some buyer hit a seller who was sitting on the offer at 1066. Now since that trade happened, there were some market makers who jumped in there. So now if we were to see a green print go through, it would be at 1062. You might notice a couple white prints here, and when you see a white print, it's because it takes place between the best ask and the best bid. It neither hits the ask nor the bid, it takes place somewhere in the middle. And two other colors you might see every now and then. If a trade goes off above the best ask, let's say a print went through right now at 10.7, that would be bright green, basically indicating that the trade went through above where the best seller is sitting. or a pink print. You'll see those in times of panic sometimes. A pink print would be, let's say, if a trade went through at 10.5 right now, which is well below where the best buyer is sitting, the best bid at 1061. When I'm watching time and sales tape, I am paying attention to the colors more than anything else because it helps me figure out what side of the level 2 box most of the action is taking place on. Another basic concept you need to be aware of with level 2 is that sometimes the size that a market maker is showing could be a lie. Here's a decent example. So we talked about how we had this 5,000 share print at 1061 hit the bid on ECIG. It hit this CSTI bidder. So why is he still sitting there? He's only showing that he wants to buy 5,000 shares. So if he just bought that 5,000 shares that somebody sold to him, why is he still there? Sometimes market makers can hide size. In reality, this CSTI guy could want to buy 20,000 shares. He could want to buy 100,000 shares. He could want to buy 500,000 shares. But he can disguise it and only show 5,000, and we have no idea. So we have to watch time and sales tape. And if we see print after print after print hit 1061, and with some significant size too, we know that that guy is soaking. That guy is buying a lot. And there's a chance that as people pick up on that, more buyers are going to jump in at the 1061 level, maybe start hitting the offer at 1062 or 1065, and they're going to cause the stock to uptick. One other thing to be aware of with these market makers is that they only display once on each side. What I mean by that is look in this box right now, the level 2 box, and notice that you don't see any market maker more than once per side. That's because at all times they're only going to show what the best bid is or what their best seller is. So CSTI, for example, at 1061, there could be another CSTI buyer at 1060. There could be another at 1050. There could be another at 10. But we don't know about those guys yet because that 1061 bid is there right now. And that's the only one that's going to show because it's the best one. This applies to all market makers, and it can be a bit frustrating because it does leave you with incomplete information. So when is level 2 most useful to me? Usually it's in times of volatility only. If the stock is just crawling along and consolidating, I try not to put weight into factors like how many market makers are on the best bid versus the best ask. But during times of volatility, like when a stock is spiking or when a stock is panicking, that is when I'll take note of things like that. When does it look like the momentum is getting ready to change? When does it start to shift from there being a wall of buyers to suddenly there being a wall of sellers instead? During those volatile times, level 2 is great for helping me pick tops and bottoms. So as you can see, there are a lot of subtleties to level 2, a lot of little things to be aware of, a lot of little things to pay attention to. I know in my case, it took a lot of time and a lot of practice watching it to get a good feel for it and get comfortable. But now let's get a look at a couple real-time examples on OTC stocks, and then we'll also look at one listed stock example as well so I can show you how it differs and how it isn't nearly as useful. So now we're looking at ECRY, and we're joining ECRY as it's in the middle of a panic. I talked earlier in the chapter about the stacking action we see on level 2 for OTCs, and this is a great example right here. Just watch how the market makers on the right-hand side of the level 2 here, the sellers, keep coming down to pressure the buyers, and how we have a big wall of them forming. Right now we have 7 at the best offer at 46.66. None of them showing any kind of significant size, but still most of the prints going through on the time and sales tape are red or pink prints, meaning they're hitting the bid or below. And still the bidders never really put up a fight. They just keep getting chipped away. And the price keeps on dropping down. So what we're looking for is we want to figure out, when is the trend changing? When does the bid start putting up more of a fight? When does the ask stop looking so stacked up? Maybe we start seeing more green prints instead of all these red and pink prints. So as the sellers continue to drop down, suddenly we see the bid start to stack up a little bit. 43.5 for a brief second had 4 bidders. And if you look at the time and sales tape right now, a flurry of red prints go through, including one for 75,000 shares. Yet the 43.5 bid held, and not only that, you briefly had an ARCA buyer come in there, jumping above some of the best offers, trying to push it up. The ARCA buyer got taken out, but the stock started upticking. It just happened way too fast for me to even narrate. So I suggest you go back and watch that turn a few times. But the lesson I want to get across in this one isn't necessarily how to pick bottoms as it's turning. What I want to show in this one is that just because you see a turn on the level 2 doesn't mean the bottom is officially in. You can have fake bounces. Now let's look at it in reverse. All these bidders are starting to stack up. They're starting to try to push it higher. 45.4 has been selling a decent amount. We've seen some pretty good sized prints go through at 45.4. And yet it continues to stack up. Now we have 4 market makers that are selling at 45.4. And the bidders are starting to drop off at 45.39 as 45.4 continues to stack up even more. And now we're starting to see a little bit of panic. A few pink prints went through at 45, and we're starting to downtick again. Now, as we fade right back down, I want to see if it's going to hold at 43.5 like it did last time, or if we're just going to crack right through and go. Most of the time, I would have tried to sell by now if I was trying to play this bounce. I would have tried to take off into that strength as it was turning. Because once it gets weak like this again, the chances of filling into downside, of filling into panic like this, are very, very slim. Just like that, we're to new lows on the day. So just for the sake of practice here, let's keep watching this and let's see if we can pick out when it's turning again, the next time it tries to bounce. So far the ask isn't stacking up quite like before, although right there 42 did stack up pretty quickly. '41s continue to get chipped away slowly. Finally, the 41 area cracks and we're down into the 40s. And it's still constantly just 5 or 6 market makers constantly jockeying for best position on the offer. But now here's where we start to see the momentum change. 40.1 stacked up very quickly, and then we had a big night bidder come in at 40.51. All of a sudden, here we go, the stacking action is reversing again. Decent number of green prints are going through. Bid continues to stack up a bit. Market makers are dropping off the ask. An ARCA buyer comes in, and the stock upticks. So for an example like that, it's not necessarily practical to think that you're going to fill on those bounces. It's maybe not even safe to try because they happen so fast. And you saw what happened on that first bounce that was a fake. OTC bounces have gotten a lot choppier than they used to be. But a couple of my biggest trades have come on the ones that were very smooth, where it's just a massive panic followed by a massive bounce, and there's really not that choppiness on the level 2 like we just saw. So this is more just to introduce you to the concepts, the idea of watching a stock turn. For this example and my coming examples, I suggest you go back and you just watch the action again and again on mute. That's what I did when I first started trading. There was somebody who would put level 2 videos to their blog, and I just decided to watch those as much as I could after market hours when I could just really focus on the action and try to get a feel for what was really going on. And that's how I basically learned to trade level 2. So don't just stop here. If you ever see an OTC that actually trades pretty liquid, has good action, film the panics, film the parabolic spikes. Just try to get some of that turning action on film and practice going back and watching it and seeing what's happening on the tape so you can identify it real time in the future. Let's take a look at another example here, ECIG. And right now ECIG is gaining some momentum towards the downside as it's trying to chip through the 15s. You might have noticed that the 15 area was pretty stacked up on the bid side at first, but it did just get chipped through like it's nothing. So just because you might see one side stacked up, that doesn't mean it's an automatic buy. Make it prove itself first. And that cracked under 15 pretty quickly. And now it's testing the 14.6 area. But right there, 14.6, a big bid came in. Market makers started jumping at 14.65. One jumped in at 14.66 now. $14.66 took a couple hits of decent size, held up. So it looks like it's going to try to push back towards 15. 14.69, the bid just soaked a couple more big prints. So I'm watching this start to uptick now. And that 14.6 was low of the day. So as this pushes, I'm not convinced yet that it's going to hold. It could just be another fake bounce. The 15 area has stayed very stacked up, and sellers are starting to come back in. Mica and CSTI dropped down to 14.95, and now all of a sudden all these market makers are jockeying for best position on the offer again. Now 14.85, there's a few of them. So what I look for in situations like this, again, I want to see, is that 14.6 area going to crack or not? If 14.6 defends a second time, or if it sets a higher low, then I'm a lot more interested in a potential bounce play. Or maybe on the flip side, I'm a lot more interested in covering my short. $14.75 had a 100,000 share bid that got taken out. Right now, the time and sales tape is pretty much all red and pink prints. But now a couple green prints sneak through. And 1475 stacks up all of a sudden. We lose one of the sellers at 1476. And we're just waiting to see, is this going to start upticking? And finally, we get that uptick. And so now we've held that 14.6 area twice. And that opens the door to there being a lot more of a bounce now this time. The second piece to the puzzle now is that it has to get through 15, of course. Same area it topped out last time. But once I've seen that higher low, that's when I feel a lot safer going after it. Both of these examples were definitely tougher examples of seeing stocks turn. But if you can see it on stocks like this, you're going to have no trouble seeing it on the easy ones when they come your way. Let's wrap up by taking a look at one more OTC example, but this time let's look at a stock that's spiking rather than a stock that's panicking. These are the situations I find myself in more when I'm looking to sell a stock into a spike or short a stock into a spike. I don't play bounces very often. So here we have AMLH, and as the market is opening, you can see how stacked up the bid is and how thin the ask is on AMLH. And almost immediately we start upticking. You can see big bids in there at 17 cents. Now another one comes in at 17.5. And the ask today is very thin, and this stock is just upticking incredibly quickly. Looking at the time and sales tape, most of the prints coming through on the offer. Lots of green prints. So as I watch this, what I'm looking for is, when does it change? When does the ask start to soak up a lot more size? Right now it's just little 2,500 share prints, 5,000 share prints, and you uptick. So I'm looking for the point when you start to see a lot of green prints go through with meaningful size, but that market maker on the ask isn't giving way. So right now is the first time we've seen 3 market makers on the ask. We have 3 sitting at 22. Now that doesn't mean the momentum is changing yet though. I'm still watching the time and sales tape. I still need to see that those 22s are soaking size and not upticking. And good thing I didn't try to sell there because it did just uptick. It only took a few small hits and the 22s are taken out. So really, while I'm watching the stacking action, I am probably paying closer attention to this time and sales tape. And so now things start to get a little bit interesting. We suddenly have 4 market makers at 23.4. 23.4 just took a 55,000 share hit. Still have prints going through at 23.5 and 23.4, but these market makers aren't dropping off like they did before. We're also starting to see more red prints come in at 23.39. We continue to see hits at 23.4, and another market maker comes in on the offer. We've been stalled here at 23.4 for a while now, and now one of the bidders drops off. Some more red prints start to come in. We get a pink print below the best bid. And this is that turning action where I'd be looking to sell here, whether it be selling a long position or selling short. But this is a clear change in momentum. And now the bidders are getting chipped away. You still see some big green prints go through, but those sellers just do not go away. And then we get the downtick, and the stock starts to pull back. So just like a stock panicking can have fake bottoms, a stock spiking can have fake tops. So as I watch this pullback here, I know eventually it's going to catch itself. I know eventually it's going to try to bounce. And the question then becomes, is 23.4 going to act as a top again, or can it reach new highs? If 23.4 holds as a top again, or if I see a lower high, I'll be pretty confident that the short-term top is in. But right now it is still in that pullback phase. It is down ticking. You have that offer stacking up and lots of sellers coming in. So for practice, you could watch here and try to pick where is it going to turn, where is it going to bottom out and start to uptick again. Hopefully you can see here how 21.55 is taking some sizable hits, but those market makers aren't going away. And now the bid stacks up. And in a moment, we should start to see the offer thin out a little bit. And so after all that selling, we are only a couple cents a share now off of where it topped out previously. And so as it tries to uptick here and spike back, let's see where it loses momentum this time. We're right back to that bullish action now. Bid is stacking up, trying to push through this 22.5 area. Got the uptick, the bidders keep on moving up. But there is a bit of a wall here now in the 22.9 and the 22.76 area. Another seller comes in at 22.76 and another seller at 22.9. A lot of 10,000 share hits going through at 22.76. But even though those market makers are only showing 2,500 shares, again, we're just not upticking. And momentum starts to shift again. And this is a lower high this time. Last time it did this at 23.4, now it's doing it at 22.76. So in my mind, that is a very bearish sign. There's good odds we get another leg down. And if my first position had only been a starter, if I'd only sold part of my long, this is where I would want to be getting out a lot more or selling a lot more aggressively. And there's the downtick, and we start to fade off yet again. Let's wrap up by taking a look at what level 2 looks like on a listed stock. We're joining NDRM here on a morning panic, and as you can see so far, this action is nothing like what you just saw with OTC stocks. It is much, much faster. There's really no real stacking action. The stock is just bouncing all over the place. That's not to say there isn't an edge trading these. It's just that this is why I tend to focus more on charts than I do on level 2 when it comes to trading listed stocks. I just don't feel that the level 2 can help show me tops and bottoms quite as well. There may be little clues that I might use to cue in on, such as if a big bid or ask comes in, or I'd look at the time and sales tape and see if I can identify if the bid or the ask is soaking a lot of size. But aside from that, there's just not a whole lot I can do with this. So let's take a look at an example that relates to that idea of looking for big bids and asks and how the stock reacts to them. So here we have CNDO, a stock that is spiking to a new high of the day. And what you're going to see here in a second is CNDO is going to start to pull back a little bit and a big offer is going to come in. So here's that big offer at 481. You see almost 12,000 shares through market maker NASD. And a lot of red prints start hitting the bid. A lot of sellers are coming in. That big offer is kind of scaring people. But the 470s soak all that size, and the stock doesn't really pull back all that much. And then that 481 ask gets taken out, and once that big ask that scared everybody and started to cause sellers to come in and smack the bid is gone, you're going to see CNDO start upticking as a result. So I know that all just happened pretty fast, and that's one of the issues with level 2 on listed stocks is it moves very quickly. So if you didn't catch all that, definitely go back, rewatch it a couple of times. I know my audio didn't quite keep up, but this is a good one to study because it's definitely a good example of what I'm talking about. One last topic I want to cover relates to viewing your time and sales tape. If you right-click on the time and sales box, this is the window that will pop up, a time and sales configuration. And what you can do in here is this handy little trick. If you look here in the middle of the box, you'll see a little option that says show only sales with quantity, and then you can change it to whatever you want. So what you would have to do is check that box, make it greater than or equal to, and then whatever number of shares you want to see. And the reason I do this, I usually just change it up to 200 shares, is because if you're looking at a time and sales tape on a listed stock, you're quite often seeing a lot of little 100 share prints go through, 50 share prints. I mean, just lots of tiny prints that just clutter it up and are meaningless. And I want to see the more significant size and where it's going through and what levels it's hitting and what levels might be soaking a little more size. So it just helps me cut through some of the noise on the time and sales tape. And that paints a little bit clearer of a picture for me of what is going on. Hopefully these videos prove useful in helping you understand level 2 a little bit better, what I'm looking at when I'm watching it on the OTC stocks. If things are still a little unclear, if you want more practice, check out my blog, tradetheticker.blogspot.com. Click on the level 2 tab. There are some more level 2 videos on there with some other liquid OTC examples. Chapter 4 is going to focus around the educational services that have helped me as a trader, as well as some of my daily preparation techniques to get me ready for the trading day. In this chapter, we'll be covering useful chat rooms and services, the ones that have helped me along the way, different methods I use to find stocks, how I scan for plays, some of the specific scans I'll run throughout the day, how I turn those scanner results into a watch list, adjustments I'll make to my scans during intraday trading hours, and finally, the advantage of tracking setups with spreadsheets. When it comes to chat rooms and services, there are 3 main ones that have helped me along the way. I got my start with Tim Sykes and his Penny Stocking Silver program, while also following the free content of Investors Underground for a while before eventually becoming a member there. You're going to be hearing from both of these services in much more detail later on in this chapter. The third service really helped me back when OTC promotions were very hot, Promotion Stock Secrets. Promotion Stock Secrets was a service built around trying to get you into the next big promotion early. They would research promoters, they would research their history, and they would find connections between stocks that made them likely to be the next big pick. The research reports that they put out, and I do believe they have quite a few free ones now on their website, were a huge part in helping me understand how pump and dumps work. I was able to get into a lot of promotions early because of these guys. Even now with the OTC market kind of dead, I'm still subscribed, reading their research reports and keeping an eye on future tickers that might be promoted. And to their credit, even with the slowdown in the OTC market recently, they've done a good job of covering listed stocks, especially the low float runners. One of my favorite reports that they put out to their members was a list of all low float tickers that had yet to run. So despite the slowdown in the OTC market, they've adapted, they've survived, and I continue to be a member till this day. So how do I use these services to my advantage? A lot of people sign up to services with the idea in mind of following hot stock picks. They just want to be handed plays on a silver platter, follow the guru's instruction, and make money. They think it's that simple. I thought it was that simple. Reality is, it's not. One thing you will never see me do with any of these services is try to follow trade alerts or try to follow picks. Instead, I will use these services to try to learn from them or to use them as a supplement in my trading. For example, I will check their watch lists or their scans every night. It's great to see what their main tickers on watch are. It's great to see the reason why those tickers are on watch. And if there were any that I missed that I might want to keep an eye on the next day, I'll go ahead and add it to my watch list too. These services are also great for their intraday chat rooms. Being in a chat room during the trading day, it can be very helpful when you're trying to find plays. Rooms like the Penny Stocking Silver chat room or Investors Underground, they have hundreds of members, hundreds of people looking at all these stocks across the market. So it can be great to get quick alerts from other members in the chat if something starts to move really quickly or if something has news come out all of a sudden. The more eyes, the better. One thing I would caution against though is don't slip into trading randomness. Just because someone alerts that a stock just had news come out, that doesn't mean you should trade it. You should still stick to your niche. You should still stick to the plays that you're most comfortable with. It can definitely be tough sometimes seeing people in a chat room celebrating a big win that you missed out on. But if it's not your strategy, that's okay. It's perfectly fine to miss. Finally, these services are great for video lessons, where the gurus will make recaps of the stocks they traded throughout the day, why they traded them, what their reasoning was. This is one of the best educational tools. This was one of my primary educational tools when I first started trading. I would watch all the video lessons I could and I would learn from them. You want to see what plays the successful traders are making, you want to understand why they're making them, and then you want to take away from that what you can. So if you're going to use any of these services, use them to learn, don't use them to follow. We're going to pause now to take some time to talk to the gurus who I was with when I first started trading. We're going to talk with the Investors Underground team and we're going to talk with Tim Sykes. These guys are going to share with you some of their best tips for beginning traders, as well as tell you a little bit about their websites. First up, we'll talk with Tim of TimothySykes.com. Tim, thank you so much for taking the time to join me. Can you start off just by introducing yourself and telling everyone about Profitly?
Sure. My name is Tim Sykes. I've been trading now for 15 years. I've turned $12,000 roughly in my bar mitzvah gift money into now $4.3 million. It's been a crazy journey, and during that journey, I learned along the way that, not many people had rules to trade by. There was a huge lack of mentorship in the industry, and I know I'm totally self-taught, and I could have gotten where I am today probably faster and without so many just boneheaded mistakes had I had a mentor. So I created Profitly to help other millionaire traders become mentors to other students. And, I'm very honored that, once you have really learned your own rules and made it, you're willing to give back to the community. And Profitly is a community now of over 70,000 traders, all trying to learn and basically become more profitable and consistent.
Okay, so a lot of traders like myself hear your story and immediately rush in to start trading. What are some of the most common mistakes you see these beginner traders making?
Yeah, everybody wants the money right away. They want to just, follow a hot pick like that. And that's not the way to making a lot of money. And I really stress this. Never follow alerts from me. Never follow alerts from anybody. The only reason why I give alerts is because I want you to see exactly what I'm thinking. What is making me get into a trade? What is making me get out of a trade? What are the catalysts? What's the pattern? What am I looking for? And then you can start to model your own trades and say, hey, Tim bought an earnings winner that was a breakout at this key level. Maybe I should do the same thing, with this other earnings winner. And sometimes I miss trades. Sometimes I'm traveling. I live a pretty crazy life now that I have so many students. And, I want you to be your own trader. I want to create self-sufficient traders. So that should be your priority number one. Not about profits away. For the first few weeks or even the first few months, you really should focus on learning the patterns and the rules and developing good habits. A lot of people make $50 or $100 on a trade here or there, but it's through luck or it's through scalping. And that's not exactly a good habit that's going to really change your life over time. So I know it's frustrating to not make trades or not to, really wait for the perfect trade. But the more patience you have, the real, focus on your long-term education and your long-term development, the better off you'll be. So you need to focus on this kind of thing as like a journey rather than just trying to make a quick extra few bucks, which is, sadly too many people do that.
So you just touched on it a bit, saying traders should start off taking it slow, not be in a rush to make a lot of money. Do you have any other advice for new traders who are trying to find their way?
Yeah, when you have a stock that goes against you for whatever reason, if you're buying this stock and they had amazing news and, it spikes for a little bit and then it just starts gradually going down. A lot of people just hold the stock, it comes back. And sometimes it does come back and they're rewarded and they're like, ha ha, I'm right, I should have held. And that's the wrong lesson. You need to cut losses quickly when you're wrong. You cannot let, a 2 or a 5% loss turn into a 20 or a 50% loss, because even if it does come back, you risk disaster. And most traders fail because they take these big losses. It hurts their account, it hurts their confidence, and they're not able to come back from that. So I always say rule number one, cut losses quickly. It's annoying to have a loss, but sometimes the best trade you can make is take a small loss. Today, for example, I was wrong on a stock and I lost nearly $1,000. But had I been like resistant, I would have lost 7,000. And in the afternoon, I actually made a good trade and I made back my loss and more. I wouldn't have made back the loss and more had I let the first trade just, crater on me and try and double up or triple up on my position. So cut losses quickly and don't add to losing positions when they're getting further and further away from you. Sometimes you just have to admit defeat, cut the loss, and move on to the next trade.
So as a teacher, I'm sure you've seen both ends of the spectrum, the students who succeed versus the students who fail. Traders like myself and Michael Good, who are now giving webinars and have taken on leadership roles in the community, we started off as just students ourselves. What do you think differentiates us from the traders who wind up failing?
I think it's diligence and having an eye on the prize. Many people, as I said, they just go in for a quick buck. They want to make a quick $500 and like get their girlfriend like a nice present. That's not what trading is about. Trading really should be used and viewed as something that can change your life. Where you can make 6 or 7 figures, and then you can get your girlfriend or your wife or your boyfriend or pets or parents anything they want once you have that. And I think you and Michael Good, you have so many spreadsheets. You're so meticulous with different strategies. It's not just about following what stock is hot in the market. It's about seeing what moves stocks, trying to piggyback moves, long and short, and really trying to get better and refine your strategy and refine your trading process over time. I would like to add Mark Crook, who's not yet a millionaire, but he's one of my most dedicated students. He just passed $400,000 in profits. He just started making video lessons for challenge students exclusively, and he is so dedicated. All of my video lessons are tagged and categorized thanks to Mark Crook. He was the one, I make too many videos. I'm just like pounding them out, trying to share the lessons. He was the one who's like, Tim, this is very unorganized. Let me organize it. And so for the first like 600 video lessons that I have, he tagged every single one by subject and ticker. And I think that's really what you have to be. You can get bogged down by how many different trades there are, how many different stocks, but if you keep accurate and detailed records, everything gets a lot easier. And I know most people don't want to do this because it's time consuming, but if you want, to really achieve incredible results in an industry that has a high failure rate, you're going to have to go above and beyond with your workload, and you're studying ahead of time so that on every trade, you're better prepared.
You mentioned that back when you first started trading, you were self-taught and you didn't have the kind of guidance that's available now. How did you prepare for the market each day, and how does it compare to how you prepare for the market now?
Yeah, I was such an idiot for so many years. I was right to trade low price stocks that were hot and active and volatile. I didn't cut losses quickly. I didn't really have risk management in place. I would have huge wins, but I would also have huge losses. In 2 days span back in 2004, I had lost 180,000 on a trade, and then I made 220,000 the next day. So I had made 40,000 in 2 days, but it was a terrible, terrible way to make it. So now with all these resources, with video lessons, with DVDs like yours, students can really do better in terms of risk management, cutting losses, and having access to what is the right path to really grow your account exponentially. Back then, people said that I was a fraud. They said that I was lucky. There was never any transparency or a service like Profitly where people would show every single trade. If you say, look, I turned a few thousand into a few million, people are like, yeah, I don't believe it. And, thank you to you for sharing all of your trades openly so that I'm not the only one. So now it's like, look, I turned a few thousand into a few million, but so did Tim Grattani. And by showing every single trade, other traders can now look and they can see the exact framework by which it's possible to grow your account exponentially. Most people think 10, 15, 20% per year is, really good. That's what they learn on CNBC. But they have to differentiate between, an individual account and a small account versus a mutual fund or a hedge fund. A hedge fund or a mutual fund would be thrilled to make, 10, 20, 30% per year. But as an individual, you have the advantage and I think a duty to really see how fast you can try and grow your account above just trying to beat the S&P 500 by like 1 or 2%. And that is what, this DVD that you're making and my DVDs really teach, these kind of atypical trading strategies that, yes, obviously they're risky because we're trading low price stocks, but they have great upside versus mutual funds, hedge funds, and diversification. You will never, ever grow your account exponentially using those strategies.
So trading these lower priced stocks that are more volatile, can you share with our viewers some of your favorite trade setups?
Yeah, there's different kinds of markets, so there's no one magic formula for everything. Like, oh, just do this, but you can get the odds in your favor. For example, there's a great, informational inefficiency with penny stocks. When a small company announces a big contract or great earnings, not many people on Wall Street notice, but you usually see the stock react. It's up 10, 20, 30, maybe even 50% on the day, and you can piggyback that news going into the market close on day one, and on day two, maybe Seeking Alpha writes an article, maybe there's an analyst upgrade. There's a delayed reaction with more positive catalysts, and more people notice it on day two because they say, wait a minute, we've got a potential runner here. Another informational inefficiency that I like to take advantage of is when there's a blatant pump and dump, where people, especially in the Midwest, bye, babe. My fiance is leaving. Where people in the Midwest are marketed these emails and telemarketed, basically advertised to about a stock, and they buy it because everyone likes tips. And that's not necessarily going to last. That's a temporary catalyst. So when the pump is ending, the people who've been marketed to, they don't know when the pump is ending because they, fell for it, basically. Hook, line, and sinker. They don't even know that they were advertised to. They just think that they're following a tip. But we, as somebody who studies, these patterns and we know how pump and dumps work, we know that the pump is going to end. And you can actually predict with, relative precision within a day or two when the pump or dump, starts crashing. When there's like the first red day or signs that the volume is fading a little bit and there's no more promotional mailers. So by analyzing what actually moves the stock, instead of just being, basically a fool who's being marketed to, you have an advantage over them. And you can short sell these pump and dumps, which is what both you and I have done very well.
All right. Well, thanks so much for joining me, Tim. Where can people go if they want to learn more about your services?
Go to timothysykes.com. I have tons of blog posts. My favorite, though, also is YouTube. I now have roughly 500 free videos on my YouTube channel. You can just Google, Timothy Sykes YouTube. I now have over 3,000 videos on Profitly, and the Trading Challenge keeps getting more and more webinars. And I got to say thank you to you because I give webinars every week. You're giving challenge webinars every 2 weeks. We're building an incredible archive of live trades and, Q&A that I think everybody should be watching because, what we've learned over the past few months and over the past few years is still applicable, and it can help people be better prepared for future trades.
Now I want to take a minute to talk to Nate and Cam from Investors Underground. Thank you guys so much for joining me. Can you start off just by introducing yourselves and telling everybody a little bit about Investors Underground?
First off, thanks, Tim, for giving me the opportunity to just have a little segment in your DVD. I know it's going to be great, and I'm excited that you did it. Investors Underground is a place where traders can get together and share ideas. It's not just about alerts, but it's more about a community that is sort of helping each other trade during the market day. We offer scans, chat, video lessons, and the 2 DVDs that we've launched over the last couple years. Now, each one of these is great in its own way. Scans pretty much prepares you for the next market day. Chat is where everybody is at, looking and scanning the markets with thousands of eyes. Video lessons is looking at each and every single trade that I made that day and what I did right, what I did wrong, and most importantly, what I could have done better. And I'm going to let Cam go ahead and just dive into the DVDs because he's the one that helped me produce them, and it was probably the best decision that I've made thus far.
Thanks, Nate. So basically, I signed up for Investors Underground probably around 5 years ago, the same way that anyone would sign up, as a paying subscriber. I wanted to learn about trading, and very quickly I learnt the ropes from Nate and some of the other big players in the Investors Underground community. I came up through the ranks, and what I noticed was that a lot of the new and existing members were asking the same kind of questions over and over, whether it was in the webinars or the chat room or the scans. So Ned and I decided that we need to put together everything that we knew about trading into a couple of DVD courses where people can watch them in a very short amount of time, get up to speed as quickly as possible in a real effective and efficient manner. So the first DVD was Textbook Trading, and the second DVD was Tandem Trader.
So, as one of the largest educational services out there, you must see a lot of new traders every day. What are some of the main issues you see them facing, some of the common newbie mistakes?
It really comes into three main things. One is lack of proper tools, such as a broker or software, lack of education, which is why we ended up making the DVDs, just to give people the foundation that they need just to understand and at least get caught up to where everybody else is at in the market. And then whether or not they find consistency from there is really up to their money management strategies and whether or not they're looking at the proper risk versus reward, and they avoid those trades that will potentially blow up their accounts like many other traders do. What are your thoughts, Cam?
I guess one of the things that I see very often with new traders is that they're really excited to get started, but I think a lot of the times they misplace that excitement by rushing into clicking buttons in a trading platform rather than really giving themselves a foundation of education so that they know what they're doing. You know, I think a lot of new traders come to the game not having a clue, and they try and click buttons and they end up blowing their account up real quick and not even giving themselves a chance to make it. That's probably my thoughts on, one of the mistakes that I see new traders make a lot.
So what do you think new traders should be focusing on?
I think there's three main things that new traders need to focus on: consistency, finding your niche, and coming to the market prepared. First thing that I do every single morning is take a look at my scan from the night before and take a look at the NASDAQ top gainers. That's going to allow me to focus in on what I should or what I could be trading that day, and then develop a game plan from there. You really need to find your niche. Everybody wants to look at what everybody else is doing and see how much everybody else is making, and that's fine. That's great motivation. But the problem becomes is if you're looking at a stock that you potentially want to day trade, somebody else is looking to swing trade it, and you start to follow their game plan, and it's not yours, you're going to run into issues. You're going to stop out before you know it. You're going to start to let other people kind of dictate whether or not you should be sticking to your plan. So the key is to just figure out what you're best at. Are you better at longing, shorting? Are you better at swing trading? And stick to that. I have a lot of people that reach out, and I just talk to them about, where are they finding most of their losses? And sometimes they might say a parabolic move on a short out of the open. And a simple fix is just wait 15 minutes. That's your niche. 15 minutes and after, look for those trades. And then last but not least, it's consistency. Everybody just wants to make, and, kill it, hit a home run. And those will come. And I always compare it to baseball. It's about how many times you can get on base. And occasionally you're going to hit one out of the park. If you go up there every single time and try to hit it out of the park, you're going to strike out. And that's it. It's just the way it is. So always focus on what can I come to the market, how can I trade, and give myself a good chance to find consistent money in the markets. And that's going to always be your foundation. Anytime you hit some type of speed bump, you can always revert back and look for those opportunities.
So Nate, you mentioned coming to the markets prepared. Could you elaborate a little more on that, what it means to you to be prepared?
Having an appropriate size watch list is a must. Everybody always doesn't want to miss anything. They always want to make sure that they have everything on watch, and they see this, and this breaking out, and then this and this and this looking like a short. If you're watching every single one of those stocks, how are you going to nail them? You potentially could trade each one, but at some point, one or two is going to get away from you. And all that work that you did finding them is not going to pay off because that one or two that you're not watching is going to take all your profits away. So the key is just to trade less and look for those perfect setups and wait for them to come to you. Have that game plan for trades, entry, exit, and if it doesn't work, having that stop in your mind is that part where it allows you to be wrong. And if you never have that, you don't really know where the trade is quote unquote wrong. One other thing is about waking up early. I see a lot of people just jump into the chat at 9:15, 9:20, and they're like, hey, what's going on? What's the hot stocks for today? And if that's you, it's possible that you find some success. But if you want to make a long-term gig out of this, you need to take it more seriously. And you got to treat trading like a job. You got to watch pre-market activity. You've got to be there at 7:30, 8:30, at least an hour before market, just to kind of get a feel for what's going on, be in the right mindset, and be ready to react out of the open.
So once you're prepared and you know the top stocks you're interested in for the day, the next step is actually placing your trades. Can you tell us a bit about your trading style and what goes into that?
Most of what I do is based off of technical analysis, and that's really just using charts, volume, and getting a feel for what a stock could potentially do based on what's happened in the past. Typically, a setup that looks a certain way may break out, and typically a setup that looks a certain way should break down. And that's a lot of what I do. Other things that are important is to have trading rules, trading the ticker. Anytime that you find yourself at the Finance Yahoo message boards trying to figure out, hey, this stock should go back up, right? I'm long and, I'm down, but I don't want to take the loss here. Anytime that you're doing that, you're already not in the trade for the right reasons. You went in with a plan, now you're down, and now you're trying to rationalize why you should stay in it. Cutting losses. Cutting losses is one of the most important part. One of the things that I had talked about in my DVD was if I had gone back to just 4 or 5 days of my worst losses back in 2010, 2011, I would have saved probably about $250,000 or $300,000 each year just by having a, as I call it, oh shit number, where no matter what, you hit the eject button at 10 grand. That's for me. Some people it might be 500. Some people it might be 1,000 or 5,000. Whatever it is, you need to have that number and stick to it.
One of the things I find most impressive about Investors Underground is that your room just seems to be loaded with successful traders who have made hundreds of thousands of dollars, including some guys who are even younger than me, like Derek or Nikos. What do you think makes these guys so successful, and why do they choose to trade at Investors Underground?
Guys like Derek and Nikos, these guys can fall and then bounce back quickly. And that's really what it's about. We've talked a lot about consistency and how you need to be able to go back to those roots. And somebody like Derek is a great example. And same thing even with Brandon, Crawfish Po' Boy on Twitter. These guys had made a whole bunch of money and then they hit a wall and it just, kind of slammed back down, reset, refocused, went back to consistency, what they originally were made of, and continued on. And each time that they hit a wall, just like Nikos most recently, just ended up blowing out a couple of accounts on PPMD with a stubborn trade. You never really know what's possible until you get there. And until you have these experiences, you're not going to become the best trader that you can become. You need to fail. You need to see that, hey, the market is always right. And no matter what you think, if you don't think it can go any higher, damn right it can. It's really about having the passion, persistence, and the ambition. And you can't be afraid to fail. Obviously, it gets easier the more money that you have and the more that you don't need to make. But it's about having that team. It's about having the people that around you. Surround yourself with those successful people. And at some point, it's bound to rub off on you. And that's kind of what our community is about and why we have a lot of not just new traders, but pros and really big name type traders that are in the room. It's highly active. It's noise free. And it's all actionable alerts. It's not just random stocks that are trading no volume, low floats. It's stocks that are trading millions and millions and millions of dollars that, they might be popping out of nowhere and, why is it moving? And all of a sudden we have the reason why. Also different big breakouts and things that everybody's sort of watching for the same thing. And it's just having that ability to have all these eyes in one spot to not really miss anything.
Thanks, Nate. Before we wrap up, can you share a couple of your favorite setups with our viewers, the ones that you'll get really excited about when you see them come around?
I have a couple favorite setups, and I probably say that every single one of my setups is my favorite, but my best long trade is when a stock breaks out of a channel on a daily chart and it has a perfect setup for a breakout. That next morning, if it has a relatively weak open and it starts an ABCD setup, which is one of the setups that I go over, and it looks like it's about to perk red to green, it's near a whole number, I absolutely love that trade because it's such a high quality, good risk versus reward type of play. You always need to surround yourself with volume, with potential red to green moves, with potential whole numbers or half dollar marks, and big spots where if you can combine a whole bunch of different things, it's going to give you the best bang for your buck. It's going to give you the best spot where everybody is looking. If you've got the guys that are using a 5-minute, 10-minute, 60-minute chart, a daily chart, whatever it may be, when all these eyes come together, that's when you get that big move. And then the other one is a gap up parabolic, a very overextended chart on the daily. Best case scenario, you've got way higher than average normal volume, something that might go from 2 to 5 one day and then gaps up around 580 or 6 and it runs to 650. That's one of my most favorite types of trades to really anticipate it. But the only thing is it's not for a new trader. It's really something that you need to be able to anticipate on your own and not ask, hey, is this a good short here? Because those are the type that can run you over and really run you out of money.
Thanks so much for all of your help, guys. If people want to learn more about Investors Underground, where can they go?
Thanks, Tim. If people want more information, they can reach out to me directly. I'm at cam@investorsunderground.com. Drop me an email, let me know a little bit about your trading, and I'll be able to sort you out with the best deal and get you started in the right direction.
Now that we've talked about some of my favorite services out there, let's move on to how I find stocks. Like we just talked about, chat rooms and services, that is a way that I will find out what stocks are in play. But just remember, don't be a sheep, don't follow picks. Simply use these services as a tool to find out what the hot stocks for the day are. Other methods I use to find stocks in play are stock promotion emails, Twitter, but my primary tool is stock scanners, where I can scan the market with my own criteria. Let's talk a little bit about stock promotion emails. We're going to cover this a lot more in depth next chapter, but for now what you need to know is that there are very few promoters that I care about right now. I only focus on the promoters that can produce spikes and volume. If the promoter can't bring in volume, it doesn't matter if the stock moves, it's not tradable. I'm not going to be able to get quality executions, I'm not going to be able to get in and out, so it's pointless to try to trade it. There are only a couple promoters right now that I would even think about buying, and then there's a couple D-list promoters who are less effective, where their stocks have brief spikes, and then usually I would look to short sell into that spike. If it is one of those major promotions, I will watch it throughout the promo. I'll watch the chart throughout. I'll look for breakouts to buy. I'll look for overextension to short. I don't only care about day one of the promotion, I'm watching it throughout its life. And like I just mentioned, some D-listers that do have occasional runners, but these promotions are usually one day and done, and if anything, I will just short sell into a spike. Twitter is another great tool for finding stocks in play. Many top traders on Twitter, they will share thoughts and ideas throughout the day. I only will use this to see what stocks are in play though. Do not try to follow Twitter alerts. A brief story I have to try to drive this point home. I know a trader who had just started using Twitter, and he followed all the top guys. He wanted to see what they were doing. One day, one of these top traders that he was following was tweeting about a position he was entering on the short side. It turns out the entry was way early. The stock still had a lot higher to go. But because my friend saw this top trader taking this position, he decided to do the same. He sold his long position and he started short selling as well. Well, then the stock kept squeezing and squeezing and squeezing, and all of a sudden, my friend was in a position that he was down a lot of money on and he had no real plan for. He only entered the trade because he saw another top trader doing it. He wasn't trading his niche, he wasn't trading his plan, he was simply trying to follow someone else's idea because that person has overall had a lot of success in the markets. Sometimes following may work out, but those plays will come along where the top trader is wrong and they have their own plan, they know how they're going to manage it if they're going to be early, And you're going to be left sitting on the sidelines wondering, what on earth do I do now? Because you don't have a plan of your own. So see what the hot tickers are, see what's being talked about, but don't try to follow people. Another opportunity on Twitter is that some accounts have flow, as we like to call it, where either a promoter or someone with a large following will tweet out, hey, this stock is a buy. And then suddenly you'll see the stock start to spike because people are trying to follow their advice. If you can identify an account like this, where the stock will move upon their suggestion, that is a possible scalping opportunity, where you can take advantage of the fact that people are going to try to follow it, and you can try to be very quick to enter and very quick to exit. This is different than trying to blindly follow someone's advice, because this is your own plan. This is you recognizing that they can move the market with their tweets, and you're trying to just scalp it and take a quick play off of it. In order to get the quickest alerts for Twitter, I use an application called TweetDeck. I have a separate account that only follows a few accounts that I think might have this ability, and anytime they tweet, I'll get a pop-up notification and it will put me in the position to act quickly. But the final way I find stocks, and the method that we're going to go into the most detail on, is by using stock scanners. That is my main tool for finding new stocks to trade. There are a few options I would use for scanning the market. There are applications called Stocks to Trade, Equity Feed, and Interactive Brokers. Interactive Brokers, of course, is a broker. You would get the scanner with their trading platform. That's one of the cheapest options. That's just a few dollars a month, I believe. Equity Feed and Stocks to Trade, those are going to cost a little bit more. Right now, I mainly use Equity Feed because they have more search options. You can refine your criteria a lot more, narrow your search. But Stocks to Trade does have a new application coming out. I haven't had a chance to test it yet, but I am going to check it out once it's out. I'm excited to see what they've put together. It's supposed to be a whole new program, so hopefully there are some exciting new options there. If you're looking for free scans, you could use Thinkorswim or you could use FinViz. Those are the two that I've tried out that are free. There are less search options. You can't quite narrow your search down as much. But if you're looking to save a buck, it's better than nothing. Thinkorswim is a desktop application. You download it for free. There's also free charting with it, like I've mentioned that I use. FinViz is a website. You go to finviz.com, and then you can click on their stock screener and then start putting in whatever criteria you want to. An example of how these are less functional though, FinViz, you can't scan for OTCs. So every night I use my scanner to build a watch list. I will run my typical scans and then I will check the scan results on the charts. So any stock that shows up on my scanner, I check a daily chart, I look to see what the daily chart pattern looks like, and then I decide if it's worth being on my watch list or not. I also constantly scan throughout the trading day. I don't only want to scan at the end of the day. I want to know if something new comes up. If a new stock pops up in the middle of the day, I'd like to be able to see it pretty quickly. So I do have scans set up to find those as well. Now, what scans should you build? What should you scan for? There is no right or wrong way. Build one that's right for you. Build one that will fit the type of plays that you are looking for. We're going to get into my scans in detail in just a minute here, but I really want to stress that. My scans are not the perfect scan. They work for me. They're what I need. But for you, what you need, it might be entirely different than me. So play around with them. Put in your own criteria. Don't feel like you have to follow what I do exactly. Now that we've cleared that up, let's look at my main scanner, Equity Feed, and how I use it to find plays. The scanner I use on a daily basis to find stocks that I want to trade is called Equity Feed. While it does cost a monthly subscription to use Equity Feed, I've found it to be more than worth it because right now, it is the most in-depth scanner that you can find. There are multiple criteria you can enter, and you can really narrow down search results to find exactly what you're looking for. For a while, Stocks to Trade and Equity Feed were the exact same software, but recently Stocks to Trade split off, and now I'm not sure what their future is. I think they're developing some kind of new software. So I can't really speak to that and how it's going to be until I have a chance to test it. This Equity Feed scanner has treated me very well though over the last few years, and I probably will stick with it unless Stocks to Trade really offers something mind-blowing. So let me show you how I build scans with Equity Feed. There is a button here that says Stock Scanner, but instead I actually use their filter builder. I'm building from scratch. And when you click filter builder, you get a window that looks like this. And this is where everything happens. This is where you set your criteria. Now the first things I look at, and this is going to be true for almost every single scan that I run, is select markets. I need to decide whether I want to be looking at listed stocks or OTCs. If I'm looking at OTCs, I want to uncheck these 3 boxes. I want to only scan for OTCBB and pink sheets. Or if I want to look at listed stocks, uncheck these 2 and check Amex, New York Stock Exchange, and NASDAQ. When I'm scanning, I will scan for either one or the other. I'm not going to have them all selected at once. Now, when it comes to stock types, it's a lot easier if I tell you what stock types I look at as opposed to all of the ones that I don't. I'm going to start by unselecting all of these. Now, of course, I want to trade regular securities. I don't trade preferred securities. I don't trade ETFs. And now we get into a big list of letters here, and most of these letters I don't care about. You'll notice sometimes with stocks that they will have 5 letters in their name instead of 4. And the 5th letter, it has a meaning. Right here, it lays out for you what the meaning of all those 5th letters are. I'll make this easy and tell you the ones that I care about. I care about stock splits, I care about delinquent ones, and delinquent tickers are ones where they maybe missed a filing, so they get an E tacked onto their ticker until they fix it. I care about foreign stocks, and then I care about bankrupt stocks, stocks that end in Q. Everything else doesn't matter to me, so I will leave it unchecked. So all scans, whether they're OTC or NASDAQ, they will have this in common. It'll be for Q stocks, F stocks, E stocks, D stocks, and regular securities. Now, if you wanted to, you could search amongst certain sectors. I don't do that. I'm just searching the entire market. I care about what's liquid, what has great volume, what has nice range, and that's it. That's all that I look for. But when you run your scans, you may want to run something totally different than what I do. And you can really narrow things down by selecting what sector you want to be looking at. You also could look for stocks that had recent news. Maybe they had news today or in the last 3 days. They had earnings today or in the last 3 days. Again, something I don't use, but you can pay attention to that. But most of my scanning, it takes place in these analytics right here: price data, liquidity, and technical overlays. If you click on any one of these things, you get a drop-down menu, and you can start looking at criteria that you might want to select, such as price. I could say that I want the last price the stock traded at to be greater than or equal to $1. And then all I have to do is hit add, and that's going to be in there. And if I ran that right now on all stocks that are listed, I would get an absolutely massive list. There are a ton of tickers in this. But still, it's cool. You can select what criteria you want and you get something spit back to you. And you can have multiple criteria. Maybe I also want the last to be less than or equal to $2. Add it, run the filter again. There's still a lot of results here, but it's less. And these are all the stocks that are listed that trade between $1 and $2. If you really wanted to narrow it down, then you can start looking at liquidity, such as volume. Maybe you only want the ones that traded big volume today. So it's between $1 and $2, and you want it to have traded at least 5 million shares. And you add that, you run your filter again, and now all of a sudden, our list is only 2 stocks, IO and SD. One was up 1%, one was down 1%. But there are tons of different things you can select for your criteria through this menu. You can look at different indicators. You can look at random overlap studies like Bollinger Bands, simple moving average, volume, dollar volume, average daily volume for 2 days, 5 days, 10 days, 60 days. And number of trades, whether it's for the day or an average number of trades. And then, of course, all the price points. Last, percent change, highs, lows, range. So there's plenty in here for you to work with. So hopefully this kind of makes it clear as to why this is my favorite scanner. There are just endless possibilities for what you can look for. But now let me get a little more into the specifics of what I scan for when I'm doing my nightly watch lists, and then show you how I use my scan results and turn them into the watch list. There really are two main setups that I'm looking for on daily charts every night. I'm looking for stocks that are building up towards a breakout level, or I'm looking for stocks that are running very far, very fast and getting overextended. In both cases, if I'm going to find a new stock on my list, it's going to have to be a stock that was up on the day. So when I'm scanning, whether it be for OTCs or for NASDAQs, I'm only looking at gainers. I don't care about stocks that were down. For the purposes of whatever scan you decide to run, maybe you do, and that's absolutely fine. There is absolutely nothing saying that our scans have to be identical. So let's start with OTCs and how I would scan for OTCs. So of course, first I have to select the markets, which means no Amex, no New York Stock Exchange, and no NASDAQs. And stock types, I have to fix that again. I want Ds, Es, Fs, regular securities, and Qs. Once I have that taken care of, it's just price data and liquidity that I care about. Now, I don't trade sub-penny stocks for OTCs, so right off the bat, I want the last trade price to be greater than or equal to a penny. And then I add that. As far as a maximum price goes, I don't really care. If it's volatile, if it's liquid, I'll trade it at any price on the OTC market. So I'm not going to set a maximum price. From here on out, it's just liquidity for me. So I'm going to scroll on down and do the liquidity drop-down menu. And now this is a very important distinction. I'm not looking at volume, I'm looking at dollar volume. And here's why. Because I have no maximum price, I could be finding stocks that are any price above a penny. A million shares traded at a penny is very, very different than a million shares traded at $50. The dollar volume is a huge, huge difference. So I care about how much money traded in the stock, not how many shares traded. So I'm going to look at what the day's dollar volume was. And I want the day's dollar volume to be greater than or equal to 500,000. And then I will go ahead and I'll add that. $500,000 of volume at the end of the day, that's not asking much. And really, that is on the low side for me. Generally, I like to be more like a million or higher. But I do cast a little bit wider of a net just because I want to make sure I'm seeing everything. And the last liquidity filter I'm going to put in is number of trades. And the reason the number of trades on the day matters to me is because I want to know the nature of how that $500,000 in volume traded. Was it 2 or 3 big trades throughout the day that equaled that $500,000? Or was it a steady flow of volume, lots of smaller trades going through? That is what liquidity is. So for day's trades, I want it to be greater than or equal to 400 trades. Again, on the low side of what I like, but that's okay. This is going to cast a narrow enough net for me. So I have my liquidity filters, I have my price filter. The last one I need is the percent change filter. I need to make sure I'm only looking at stocks that were up for the day. And I can do that up here in the change category. So net change is greater than or equal to, I can make it 0, I can make it 5, I can make it 10. What I do for my scan is I'll say I want it to be greater than 0. I just want a stock that was up on the day, that's it. And once I have that, my scan is complete. I can go ahead and click Save As, type in OTC Nightly Scan or something like that, hit OK, and then it will forever be there for me to come back to. I don't have to make this scan from scratch every single night. And let's just run that filter and I'll show you what we got. And on this specific day, that spit out 7 tickers for me at the end of the day. Now that doesn't mean all 7 of these make my watch list. And in a little bit, I'm going to get more into how I narrow it down and figure out which ones do. So now let's talk a little bit about the scan I run every night for listed stocks. And it is pretty similar to my OTC one. I just have to change around some of the liquidity requirements and some of my percent change requirements. So of course for the markets, I want it to be NASDAQ, New York Stock Exchange, and Amex. We're not looking at the OTCs and pink sheets anymore. Stock types are going to remain the same. The Qs, Ds, Es, Fs, and regular securities. I'm not even sure there are Ds, Es, Fs, and Qs for listed stocks, So usually I'm just finding regular securities with my scans. When it comes to price, I want my last price to be greater than or equal to 50 cents. For whatever reason, I'm just not very comfortable trading the super cheap listed stocks. So 50 cents is a good cutoff point for me. I also want there to be a maximum price. I want the last price to be less than or equal to $20. I don't like trading the really expensive stocks, except in very, very rare cases where there might be a super volatile one. Generally, this is the price range I need to be looking at, though. I don't need to see any stocks that are more expensive than 20, so I just cut it off there. When it comes to change, I want to look at percentage change, and I want the percentage change to be greater than or equal to 15%. Again, I'm looking for stocks that are building up towards a breakout, or I'm looking for stocks that are getting wildly overextended. So 15%, that really casts a narrow net. Cuts out a lot of the random noise for stocks that are up 5% to 10% on the day. I don't really want to see those. I want to see the ones that are really up and really worth my eye. After that, it's just a matter of liquidity requirements. Dollar volume, again, is what I use, not regular volume. And the day dollar volume that I've settled on is greater than or equal to $3 million. It's a little bit on the low side again, but it is still going to be enough to cut out the very illiquid ones that I don't care about. And then as far as number of trades on the day, I want days trades to be greater than or equal to 3,000. Once again, you can save the filter, put in NASDAQ nightly scan or something like that, click OK, and there you go. It's there for you to come back to for all eternity. And let's just run that filter, take a look at what we get. And here we go. It's another very manageable list. Once again, it's just 7 stocks. So I can go through these stocks, and this is my starting point for building my watch list the following day. So now I'm going to show you how I take my scan results both from OTC and NASDAQs, and I turn them into a watch list going into the next morning. So when it comes to turning scan results into a watch list, the most important thing to me is what does the chart look like. So yes, my scanner spit out 7 tickers for OTCs and 7 tickers for listed stocks. But I don't know if I care about these yet. I need to look at charts. So let's just go through the charts one by one. EKSO, the first OTC that was up on the day. EKSO had very nice volume, traded a couple million shares, and if you look at this daily chart here that it's forming, it looks like it could be spiking into resistance. Today it closed at 177. In the past, it's had parabolic action. It topped out in the 230s. For a while here on the daily chart, it topped out in the 210 area. So this is something where tomorrow, if it gapped up and it continued to spike, I might be interested in a short. I might be interested once it approached this 210 area or once it approached this 230 area. If it gaps down, if it looks like it's failing, maybe I would short it because it's up from 140 to 177 on the day, and I think it has room to fade back down. EKSO, though, it definitely has good volume. It definitely has good range. This is one that would make my list. STPFQ. Looks like it just had a bad print on this day. I doubt it really ever got up to 82 cents from down at this 8 cent area. But if we zoom in on the part of the chart that matters, this basically looks like it's had a decent breakout past the 26 cent area. And now we've had a couple up days in a row. We're extended from 25 cents to 38 cents. Today we traded 2.9 million shares. It's a nice extending daily chart. It's probably not quite high enough for me yet, and the volume is a little bit on the low side. But it's something that I could definitely keep an eye on. It's something I could watch for that green-red snap. As it's going red, I might want to short it. Or tomorrow, if it gaps up and has yet another spike, I might want to short into the spike, expecting a pullback. But it's a chart I like, so it's going to be a ticker I include in my watch list. RTNB. This looked like a breakout. It broke out past the $2 area today. Only traded 780,000 shares. I feel like I probably missed the long since it broke out already. Maybe I could try buying a little bit tomorrow if it gaps up with green-red risk. But this is something that I would want to see extend more. So RTNB, for now, I'm not going to watch it too closely. It's not the most liquid OTC. Maybe I'd keep half an eye on it if I was short on plays tomorrow. But for now, it's not overextended enough. It's not of high interest to me, and I don't really think I want to buy it. So if I see this on my scan tomorrow or the day after, and it's much more extended, then we'll revisit a short idea. PPCH, this is a 5-cent stock. Maybe I'd be interested if weeks down the road it broke out past 10 cents, but it's not even close to that right now. This isn't even worth keeping on radar because it's just too far away. So PPCH is one where even though it landed on my scan, I'm not interested. CTIX. CTIX, another chart here. It's pretty beaten down, not near a breakout, not overextended, no interest. THCZ. Now this is an interesting chart. If I zoom in on this daily, we're building up towards a breakout level. It looks like it's slowly been climbing, and this 31-cent area is the breakout high that I'd be very interested in. So THCZ, I doubt it does it tomorrow. It hasn't been trading with a lot of range, so I'm not going to buy in anticipation of the breakout. I'm not interested in this for a short right now. But down the road, if it breaks past 31, I probably want it. So this is something I will keep on radar, although I doubt I wind up playing it tomorrow unless it has a sudden burst of strength. And finally, ATUSF. ATUSF, it's an interesting chart. It's only trading a few 100,000 shares a day though. So I don't think this is something I'm going to do anything with, even if it breaks out past this previous high area of 1245. So today, 1212. The high a few days ago was 1227. So yeah, it could be building up towards a 1247 breakout, but I don't like the liquidity. I really don't think it's got that much volume. And the range hasn't been great. Today its range was a couple percent. So this isn't one that I plan on watching. Now moving on to listed stocks. OHGI. OHGI, wow, this is a big spike today. It's a chart with very little volume history. It had one big volume day in the past in February, traded 1.9 million shares. It looks like it got as high as about $4 before fading off. And then after being as low as $1.03 yesterday, today it gapped up and had a very big spike. Got as high as $2.93. So OHGI tomorrow, I mean, this is nice and extended. It's up a ton from its lows today. It's up over 147%. So no matter which way this gaps, I'm probably thinking short sell. Either short into a gap up and spike, or if it gaps down, I could short and risk off of red-green area, today's closing price. OHGI definitely will make my list though. 5.9 million shares traded, tons of range. There should be opportunity here. GIGA. Another chart here with not a ton of history of volume, but it has had some big spikes in the past. And another one where it's had a big run today. Ran from the $1.70 area to $2.83 at closing. And it looks like it topped out right around $3. It has a previous top right around $3 from a run back in September. And the day where it had the most volume back in June, it got up as high as $4.78. So tomorrow, again, lots of volume, lots of range. It's something I want to keep an eye on. I want to short sell this probably. Where I want to short sell it really depends on where it gaps. So I'm going to have a plan for either way. DSCO. Now this is interesting because the scan says the DSCO last price was 135, but it's 115 according to my chart at the closing price, which means that after hours it's gapping up. Now DSCO, it's not that exciting of a chart to me. I guess there's a lot of overhead resistance, this 180 area where it peaked out. Couple peaks up here at $2. So I guess if this gapped up tomorrow and had a big spike, I'd be interested shorting into those resistance levels, but that's probably about the only play I'd be looking for. NTLS. NTLS looks like it had a nice run today from about 6 to 8. It's a beaten down long-term chart. And it did spike up into this $8 area. I'm not in love with this chart yet, though. This is one that I think I would look to short sell if it had one more day of run. So if it shows up on my scan again tomorrow, great. I'll dive in, I'll look for a play. Right now, only up from the $6 area to the $8 area. That's just not quite enough for me. So I'm going to just wait and let it play out some more tomorrow. It's not going to be a ticker I'm looking to trade. PGN, I see this chart, I see nothing I care about. Even if I zoom in, there's just nothing interesting about this to me. It's not overextended, it's not near a breakout, so I'll pass. XNET, this is building up a little bit off of its lows from about a month ago. Again, though, it's just one that's not up that much short term, and it only traded 895,000 shares today, which to me is pretty illiquid for a listed stock. So XNET, this is one that unless it has a couple more straight up days, I probably won't care. Finally, FCSC. FCSC looks like it had a gap up on news probably, had a morning spike, and then just faded off all day. It closed really weak. It's a red candle with a big wick up top. So there's not a whole lot for me to play here. Maybe tomorrow if it had a secondary push back up towards today's highs, but that's not a super likely play. I don't think there's a ton of downside given all the consolidation and the threes. So FCSC is probably not one that would make my list. So from using tickers just from my scan, this is what my watch list would look like. I would categorize it OTCs, NASDAQs, and then some that I might want to keep on radar that I think might not be an immediate play, but I want to make sure that I have half an eye on just in case. And then I'll type out a short little plan for each one, just to remind myself the next morning what exactly I was looking at. Just because these tickers are on my watch list right now does not mean that I'm going to trade them all tomorrow. These are all just ideas. I may get an ideal play on a couple of these and wind up taking trades. Others, they may go in a completely different direction than I had wanted or planned for, and I'll just leave them alone. You don't have to trade everything on your watch list. It's okay to miss plays. But this is an exercise I go through every single night in order to prepare myself for the next day. It helps me be self-sufficient, and it helps me be prepared. Fast forward now to the next day. I have a whole new list of stocks on my scanners that I need to go through and decide what should be on my watch list for tomorrow. But before I do that, I want to start by reviewing the tickers that were on my watch list the night before. So let's just start by going through those, because some of these, they're going to stay on my watch list, even if they don't wind up on today's scans, because maybe they did something that I want to keep an eye on. So last night's scans, we had EKSO. And if you take a look at the chart action, EKSO today, it did hold green. It gapped up pretty big, but it didn't really spike all that much. It never got into that area where I was looking for a short, and I never did make a play on it. But now this is an OTC that still is trading good volume. It traded 2.6 million shares. It's got 2 up days in a row without going red. So I'm going to watch this tomorrow, and I'm going to have pretty much the same plan. I'm either going to short on a green-red move, or I'm going to short into a nice spike. STPFQ. STPFQ, it looks like, had its red day today. It didn't trade that much volume again, 1.9 million shares, which isn't that much for a 30-cent stock. And I never made a play on this one either. Since it has had its first down day, it's not extending that much more. This is one I probably don't want to keep watching. I would have probably only stayed interested if this had extended way more. My last OTC was RTNB. RTNB, it did continue its breakout pretty nicely today past the 2 area. I guess it barely dipped below and then continued up. But now this is a couple days of extension on it. I still want this to get further extended. The volume still isn't that great. It was a little less volume today than yesterday. If RTNB can keep on pushing, get way more extended, I'm very interested in a short. But this is one that probably is worth keeping on my watch list. Now for the listed stocks that I was watching. GIGA. GIGA, today was carnage. It had a large gap down, and it basically flushed all day. Closed down at 210. There's really not much more for me to do with this stock. The only play I might be interested in is if it had a very big bounce tomorrow, back up into this mid-2s area near today's highs. If that's happening, it's going to show up on my intraday scanner though. So I don't need this on my watch list. It's not something I'm going to play right out of the gate. So GIGA, that's going to be off. OHGI. And that's a pretty similar story for OHGI. Gap down, red day, and volume was very light today, 1.5 million shares. So OHGI, same story. If it had some kind of a good bounce tomorrow, it would show up on my intraday scan. then maybe I'd look to play it. But out of the gate tomorrow, this isn't something I need to be prepared to attack. Finally, DSCO. And DSCO had a pretty weak gap up and flushed all day. So DSCO, that's off my list as well. Not something I'm looking for a short, and certainly not a buy setup I would be interested in. The last one I had on my watch list was THCZ. That was on the keeping on radar section that I was looking for a multi-day breakout on. THCZ didn't do much today. Another day of very small range. Traded 5 million shares, but it's not at that breakout yet, so I'll keep it on radar, but I'm not going to do anything with it until it reaches my breakout level. So now that I've established which tickers I want to keep on my watch list and which I don't, I can go into the new ones for the day. What are today's scan results? And we'll start with AMBS for the OTCs. AMBS might have had an up day, but this is not a chart I'm interested in. I'm not going to short sell a 5-cent stock, and it's really not building up towards any kind of a key resistance break, so AMBS doesn't make the cut. The next two are RTNB and EKSO. We've already talked about those. Those are ones we've gone over. We know what they're going to do. They were on my watch list from yesterday. They're going to remain on my watch list for tomorrow. Fannie Mae, FNMA. FNMA might have had an up day, closing up a couple cents a share, but this chart sure isn't interesting to me. Not near a key resistance break, not overextended for a short, so Fannie Mae does not make my list. FMCC tends to mirror Fannie Mae, and same situation here. I'm really not interested because it's not near a key resistance break, and it's certainly not overextended. So my OTCs, that's not going to change very much. Things are going to look very similar on that for my watch list tomorrow. Now the listed stocks, starting with VBLT. And VBLT today had a very nice first up day. Large gap up, big spike, got as high as just over $7, closed in the mid-6s. It also had a big volume day back in March where its top was up in the 786 area. So tomorrow, if VBLT had a nice gap up and a spike up towards this $8 area into the previous resistance, I'd be very interested short. On the flip side, it still closed up 57% today. It has room to come down. If it gaps down, if it looks weak, I may short pops. So VBLT definitely is going to make my cut. It's going to be on my watch list for tomorrow. ONTY. ONTY isn't all that interesting of a daily chart. Closed today up 36%. It's hard to want to buy a break on this though of any level. You could maybe make an argument for this area being a breakout level 212, but even if it breaks past 212, it has this spike resistance also that it has to get through, which is 235. So I'm not really sure I would want to buy that because there's still an overhead resistance level. I would consider it short tomorrow, perhaps spiking into one of these resistance levels, or if it gapped down and was looking really weak, I might short pops, risk off this $2 area. There is room for this to come down. It could fade quite a bit. So ONTY, I'm going to watch it tomorrow, but it's not the most clear cut. It's not something that I'm really itching to play, but it's at least worth keeping an eye on it. CAS. This is an interesting chart getting kind of vertical. A couple up days in a row. It's up from 4 to 6. But volume's a bit on the light side, 854,000 shares. So I don't think I'd keep an eye on this unless it got really extended beyond this even. I just don't like stocks that trade under 1 million shares. So this one snuck through on my filters. Really, it's just a little bit too illiquid for me. But tomorrow, if it were on my scan again and it got even further, I might have to consider. FES. This is an interesting chart. Looks like it had a nice big spike up through 250 today and then faded all the way back down to $1.64. The volume on the day wasn't great, 1.7 million shares. It's tradable, but it's not fantastic. FES, the only play I would be interested in tomorrow would be if it gapped up and spiked into today's resistance levels, but I don't think that's very likely. I don't like the liquidity, so this just isn't going to make the cut for me. I don't think I'm going to keep an eye on it. Finally, ATOS. ATOS had a bit of a perk up today. Looks like it's been consolidating in the 140 area, perked up to close at 160. It had been as high as the 170s. It's not up that much off of this consolidation base area though, so I can't think about this for a short yet. And I certainly can't think about this as a long because it has all kinds of overhead resistance still. So ATOS also probably doesn't make the cut. So based off of what we just discussed, this is what my watch list for tomorrow will look like. You can see EKSO and RTNB are still there. They're definitely still worth watching for me. And when it comes to the listed stocks, VBLT and ONTY, those are newcomers. The other 3 listed stocks that had been on my scan from yesterday, they all got eliminated. None of them really had setups that I thought I'd be excited to play tomorrow. Finally, THCZ, still waiting for that 31-cent breakout, still keeping it on radar. So every single night, this is the process I'll go through. I'll look at the plays that were on my watch list the day before and decide if I need to make some updates to them and keep them on there, or if they should just simply be removed. And then I'll look at my new scan results. The scans that I run intraday are actually very similar to the scans that I run overnight when I'm building my watch list. The only difference is that I have to change the volume requirements a little bit so that I cast a bit wider of a net and I can find stocks early in the day. I start every morning with this scan pre-market. This scan is designed to find the stocks that are gapping up big on good news. If we take a look here at the filter info, you can see that my criteria is that the day's volume is greater than $50,000 worth of volume traded, the stock is up more than 20%, and the last price is less than $15. I'm also scanning this through the markets, NASDAQ, New York Stock Exchange, and Amex, basically any major listed stock. So if a stock is gapping up pre-market, if it's traded any kind of volume at all, it's going to hit my radar and I have a chance to potentially find it before it has a big morning spike. But once the market opens, I need to narrow down these criteria a bit, because if I only have $50,000 worth of volume, I'm going to find a lot of really illiquid stocks. As I'm filming this, it's midday, and you can see EGT and NFVC on this list. They've both traded 92 and 93 trades on the day. Only 45,000 shares of volume and 38,000 shares of volume. These aren't tradable. These aren't things that would interest me midday. I need stocks that are liquid. I need stocks that are volatile. And yes, they're up a lot, but they're missing that liquidity. So my solution is I change the volume requirements once again for market open. So once market is open, here's the next scan that I am running, right here. And you can see I have about 10 results today. So it is a decent number that I have to look through, but it's not overwhelming. It's not too much. I know that what I'm seeing is only liquid. The filter info for this one is the day's dollar volume has to be over $3 million traded. Percent change is greater than or equal to 9%, and the last price is less than or equal to $15. And once again, this is just for NASDAQs, New York Stock Exchange, or Amex stocks. So today's big runner is CALI, and CALI up 63%, 2.4 million shares traded on the day, 5,900 trades. This is pretty liquid. This is up a lot. This is a stock that I want to watch today for plays and beyond. So if any new stock comes up that's really running big, I'm going to see it here first, and I'm going to be ready to react and possibly make a trade on it if I see a chart that I like to go with it. The final scan that I'm running throughout intraday is my over-the-counter scan for OTC stocks. And here's the filter info for the OTC stocks. Obviously, the markets are OTCBB and OTC. Day's dollar volume is greater than or equal to 200,000. So this is a much less strict volume requirement because OTCs, they're generally not as liquid. I want the last price to be over a penny just because I don't trade sub-penny stocks. I want the percent change to be greater than or equal to 3%. I'm looking for the stocks that are up on the day that might be either getting overextended or building towards a breakout. And days trades greater than or equal to 30. So just in case there's some OTC that has one big dollar volume trade, it's not going to pick that up. It's only going to pick up the stocks that have a decent number of trades on the day, a decent amount of volume, decent amount of liquidity. The reason the day's trades and day's volume is so low is because, again, this is an intraday scan. So early in the day, it might not be very liquid. It might not have very many trades. But as the day goes on, maybe a favorable chart setups. Maybe it has a breakout. Maybe more people come in and it starts to get more activity. So I'm just positioning myself again to see it a little bit early. And the results here aren't that overwhelming. Today, also about 10 or maybe 12 results on this filter. So I would maybe look through some of these charts, see if it looks interesting to me. It's a little bit of work, but I can deal with it. It's not overwhelming. And if that next big play comes up and something starts running, I will see it and I will be ready. So that really is all there is to it, guys. I don't have a lot of scans going throughout the day. This is all I'm looking for. I'm looking for stocks that are up. Like I said, I want them to be building towards a breakout level or getting overextended. Those are the charts that interest me. That's not to say that you shouldn't be scanning for stocks that are down a lot on the day. Maybe you like bounce setups. Maybe that's what you want to look for. I do what's right for me. You do what's right for you. But intraday scans can be very helpful because once your overnight watch list plays have played out a bit, you do want to see what's coming next. While watch lists are a great way to prepare yourself to trade outside of market hours, that doesn't mean your work should stop there. What I'm about to show you is something that I've been doing for various setups pretty much ever since I began trading. I've used spreadsheets to help track how stocks perform in certain situations and then try to figure out how I can make plays based off of that. What you're looking at right now is one of the very first spreadsheets I ever created. It was tracking new promotion releases from various promoters that I thought were considered major promoters, the ones that really had the best flow and could push stocks the best. Really what I was interested in, what I was trying to find out, was how much do promotions spike when these guys announce them. So I would have to figure out what the start point was when the promotion was announced. So when I got my first email, where was the price of the stock? I needed to know how low the stock got after that on day one, how high the stock got after that on day one, and then sometimes I wanted to know how it opened on day two, whether or not it'd be worth trying to hold it for a gap up. And then of course I would categorize it by pumper. I would have to make note of which promoter it was behind the pick, because I did need to know that. Different promoters that have different effectiveness. So let's just look at a few examples here. Some of the codes you'll see for promoters: BDPS, that's Best Damn Penny Stocks. PP is Penny Pick. CP is Crazy Penny. SMA, Stock Market Authority. NIA was National Inflation Association. WSF, I think, was Wall Street Fundamentals or something like that. I can't even remember them. But all these various picks, I would know how they did, and then I could look back on that when the next one was coming out. I also would do a little bit of a breakdown of the stats up here. I wanted to know that after a promotion was released, the average low that the stock would dip to on day one after that was negative 5%. The average high, past release, 63%. This is across dozens of promotions. Average day two open, 54.35%. So actually, day two open, it tended to be a little bit worse. But seeing these stats, seeing that the risk reward was in my favor, it was a huge confidence boost. And it really helped show me that buying new promotions was a strategy that I wanted to focus on. There was incredible reward for very little risk. I didn't just stop there though, I would also save the charts. I wanted to have the charts to refer back to. So right here you can see some of the major promoters and how their picks performed on day one. I have it usually marked out with a little line from the start point on the chart. And I would always be able to refer back to these. Those are just a few of the charts, but you get the idea. I had something very organized. I had something that would help me be ready for the next one. And this is part of the reason why I got so good at buying new promotions early on in my trading career, is because I was ready for them, I was prepared, and I was confident. And confidence is one of the most important things when you're trading. So after this, after my experience with tracking new promotions, after my experience with tracking how some of these pumps would do once they broke out, I knew that this was something I would always want to do when I was trying to learn a new setup. For a while, I settled into a groove when it came to OTCs. I didn't need to do this extra work. Once I got good at OTCs, I really was just trading during market hours and I didn't have to put in this kind of prep time afterwards. But then something happened. The OTC market, it totally dried up. There were far less promotions, far less plays I was comfortable with, and I knew I had to transition. I had to move over to trading listed stocks, something I had very little experience with, and I really didn't even know where to begin. So how did I do this transition over to listed stocks? Of course, I started by making a spreadsheet. When I created my first spreadsheet for listed stocks, I had to start by asking myself, what do I want to look at? And I decided I wanted to look at the stocks that had been hot for the day, the ones that had traded good volume and had had a nice run with some nice range. So I decided I was going to look at all listed stocks that had traded over a few $1 million of volume and were up more than 10% on the day. So basically at this point, I didn't know what I was looking for. I didn't know if I was looking for longs or for shorts. I just wanted to track how these stocks tended to perform the next day and then figure out if I could find any kind of a statistical edge based off of that. Now, of course, I had to categorize these because not all stocks that close up 10% or more on the day are the same. There are some that close near their highs, there are some that close near their lows. So I had to categorize them. I broke them down into 3 categories. Good day ones would be stocks that closed 10% or more up on the day and were closing near their highs. Ugly day ones would be stocks that were closing up 10% or more on the day, but were closing near their lows. And mid-range day ones would be stocks that were closing up 10% or more on the day, but were closing somewhere in the middle. And here you can just see some of the data that I would track. Of course, I would see where did the stock close and what percent up was it on the day, what was the percentage gain. Then I would see what the next day open was and what the open percentage was. Next day high and high percentage. Next day low and low percentage. Next day close and close percent. And then I'd start tracking some questions that I wanted answered. Did it gap up? Did it go green-red? Did it go red-green? Was close less than or equal to the open? Did it close red? And I could do this all through Excel and Excel formulas. I would compare percentage-wise how the close related to the high. I would also compare percentage-wise how the close related to the open. And then I would have a link right here where I could click and I could see a chart for the day. I would save an image of every single chart so I could go back and review it. Then I would have a more advanced stats page. So for the good day ones, 55% gap up, 45% gap down. 77% go green-red at some point. 47% go red-green. Closes less than the open in 71% of the cases, and it closed red 64% of the time. I then would also narrow it down. How did the gap downs compare to the gap ups? If it gapped down, it would go red-green 43% of the time. If it gapped down, it would close red 87% of the time. If it gapped down, it would close below the open 77% of the time. So a gap down was a pretty good recipe for fade. If it gapped up, that didn't mean it was safe though. It would still go red on the day over half the time in 58% of the cases after a gap up. Only 44% of those times though would it actually close red, so a little less than half of the time. And gap up would close below the open 67% of the time. So through all these stats, I started to gain confidence through listed stocks. I started to realize that I wanted to be a little bit more short biased. When there was a big runner, I wanted to look to take advantage of a fade. I'm not going to turn this into a big section on how Excel works. I'm not going to go through all my formulas and show you how to build this for yourself. That's just way too complicated. If you want to figure out how to do this on your own and you're not familiar with Excel, buy a cheap book on Excel. Just learn the basics. It's not too difficult and your eyes will be opened to a world of possibilities of things you can track. Just to show some examples of a few more stats I gathered through this, ugly day ones. Ugly day ones were stocks that closed near their lows even though they were still up 10% or more on the day. Ugly day ones, only 39% would gap up, 61% would gap down the next day. 96% of them were red at some point the next day, so even the gap ups, they faded off. 41% of them would see green again on the day though, if they did have that green-red move. Maybe it was just a quick perk, or maybe it got up there and stayed up there. 83% of them though, the close was less than the open, and 83% of them did close red on the day. So ugly day ones, that was an area I focused in on pretty early when I started trading listed stocks because this was an area where the odds were especially on my side for more fade. Then of course I would break it down again, comparing how the gap downs acted compared to the gap ups. And you can see the stats here for yourself. I'm not going to keep reading you the stats one by one. But the point is, this extra work and building these spreadsheets, they gave me a statistical edge. I still would trade each setup uniquely. I would treat each as its own thing, but I would have these numbers to guide me a little bit. I would know that the odds were on my side. And that is something that any one of you watching this is capable of doing as well. So if you're struggling, if you're looking to figure out what setups work, what setups don't work, start tracking them. Give yourself a chance to see what succeeds and what doesn't. Now that we're through most of the basics, we're going to start diving into some of the specific trading strategies I use every day, as well as live trade examples of them. Before we get into that though, I just want to lay out for you exactly what you will be seeing on your screens during my live trading examples. In the upper left-hand corner, you will always see a daily chart of whatever the ticker I'm trading is. That is so you can see the big picture of what is going on and what I am thinking about and what I'm seeing, because the daily chart is usually the most important factor to me. In the lower left-hand corner, you'll usually see a 1-minute chart. In a couple cases, you may see a multi-day chart or a 5-minute chart. I'll try to make note of that when it's a change, but you will almost always see a 1-minute chart. Sometimes a portion of the chart will be highlighted in light blue. If that is the case, that means it is either pre-market or post-market action. Of course, in the lower right, you will see a level 2 feed as well as time and sales tape. And then these two boxes in the upper right-hand corner, the bottom box is going to be my orders box, where my trade orders are going through. And then the top right box is going to be the box showing the position that I have in the stock. So right now, you'll see I have PTBI, I have 7,500 shares short. The price I'm short from is $849.99, and I've realized $1,000 on this stock so far today. You also will see, during my examples, a market clock in the upper right-hand corner, right up in this area. And that market clock, it might be good to keep half an eye on that, because usually I'm going to have time sped up a bit so that the examples don't drag on for so long and you don't get stuck watching a bunch of consolidation. So now that I've laid that out for you, let's get into it. Let's dive into the next chapter, which is going to begin by focusing on buying new promotions.